going to be a long stream. Labski, how you doing? Yep, right on. Hopefully we'll see some good stuff. I'm just going to wait for a few minutes uh, before I kind of start going over the preparation and oh, no mic? Okay, no problem. That's what this text box is for. Hey, Jason.
Mark, how you doing, mate? You good?
I'm good, man. Kind of anxious. Haven't traded since Monday. Been waiting for NFP. Been watching you guys make all this money.
That's it, mate. Keep your head up. Anyways, it's all about following your targets and your rules.
Yep.
You know the game.
Yeah,
Big day today.
I kind of set that rule. I think leading up to FOMC, there was some weird price action for a couple days, and I was like, you know what? I'm just going to see. I'm going to set out NFP and wait for the actual release. And then as I was watching, there's plenty of opportunities to trade. So I'll make a note of that, and next time I'll probably approach it a little bit differently. But
Yeah, that's it. I mean, it's all just down to experience. We learn from it and we adapt, see
that's
what
it.
we can work on next time, and that's it.
That's it.
No need to look bad on it or anything like that. And yeah, just got to keep our heads up.
Progress, not perfection. Am I coming through okay on the mic? Can you hear me okay?
Yeah, you're loud and clear, mate.
Okay.
I don't know
Okay.
if you can hear me clearly.
Oh yeah, you're perfect.
Brilliant, brilliant. I'm just gonna go off for a bit because I'm about to fit the kids. So, but
Yep.
yeah, I'll keep an eye anyways.
Okay, no sweat.
All right, brilliant.
Thank you. All right, so we got a few in here. We'll just start kind of just covering, basic information. What I like to do is uh, any trading day, not just, news event days like this. You want to get into the chart a little bit before you're going to start and kind of set your levels and understand which way on the higher time frames, what your bias is, which way the price is headed. So I started 30 minutes, 45 minutes ago going through the chart and preparing to kind of try to anticipate what levels the NFP release might drop to, and then get an indicator from there. Start looking for entries. So on the 5-minute chart, I went back in time a little bit and I marked out levels of liquidity with the red lines. So below these swing points, um, fair value gaps are automatically drew in. I drew this one in right here. It's maybe on a different time frame. I think this is a 1-minute fair value gap. And then I've got order blocks down here. So um, when NFP hits, depending on where price is at, a lot of times it can drop all the way down. It can make a huge move. You're going to see a move like you've never seen before, probably. And it's going to whiplash back and forth a couple times. And we just wait through all that. And a lot of people are going to be trying to trade that. They'll try to guess. Because if you guess right, you're going to make thousands of dollars. If you guess wrong, well, you could lose thousands of dollars. So it's just not worth the gamble. If you're, you know, practicing patience is such a big part of this. So what we've learned is we wait for all that big move, fake, all that to happen, and then once price sort of settles down a little bit, it's going to pick a direction. And when it picks that direction, then we look for our entries, and we raise our probabilities, quite a bit by not trying to participate in that first burst of activity. There's 3 or 4 of these events that are scheduled regularly, and we approach them the same way. The FOMC, when they announce the interest rate changes, is a huge effect on the market. So, you know, on that day, we approach it the same way as we would NFP. And same thing with CPI, um, Consumer Price Index. So it talks about, how much stuff costs, and There's one also for corporations, and it's not as impactful, but still can cause the market to do some strange things. So anyway, every day this should be your routine is to go in and mark your levels. So on the upside, just for the sake of being prepared, we've got upside targets up here also. And a lot of times what'll happen is it can come all the way back up here. That's the whole thing about these news events is they're almost geared to just make major sweeps of liquidity, take price to different levels, and you don't really know where it's going to go. You just have to, like I said, kind of be anticipating, um, you know, what levels this might reach to. Because the way we approach the market, this is, highly manipulated. Um, it's designed to just sweep liquidity. So we need to know where the liquidity is at. So every one of these red lines is a level of liquidity that the market's going to reach to. If not today, Frank, I'm going to mute you real quick. There we go. All right. So yeah, just part of the preparation as we get up here, and we watch for price to react to these different levels, and then we try to find our entries based on that. So anybody have any questions? I'm pretty much gearing these live streams to those of you that are the newest. So there's going to be a lot of repetition, a lot of very basic information. I'm going to a lot of it's just over and over because the repetition is what you need. You need to see what we're talking about. You're watching ICT, you're seeing us mark up trades and charts and things, and this is your opportunity to kind of see what the process is that we follow. And I encourage you to ask questions. I can see the text window down here. For those that don't know, you can open up a text box right here, and you can text. It's separate from the main chat. This is the main chat. This is your live stream chat over here. So if you can see that, go ahead and just put a 1 over here real quick and hit enter so I can see that everybody's in the right chat. Just come over here and go boom. Everybody sees this chat over here? Alrighty. Someone's messaged me here. Give me just a second.
Mark, I made it, but I'm on a tablet, so I can't go in there and put 1 on there.
Okay, gotcha. Get back to the live stream. Alright, we'll unmute Frank real quick, see if he's got his stuff going on here. Hey Frank, you got some background noise on your going on, so I muted you. I can hear your TV or something going on. It's pretty loud. Okay. Okay, well, some of you there, but yeah, I can't keep up with both chats while I'm doing this. So I'm really just going to focus on you guys in here. Okay, so 5-minute chart, and we're always aware of the higher time frame stuff also. And I like using my chart layout. I'll use the same layout. Like you can create different layouts in TradingView. Here's my layouts, but for my just basic charting, I use the same layout and different time frames. That way, when I make a notation on one time frame, it repeats onto all the time frames. So when I switch over now to my higher time frame stuff, you can see my red lines, my order blocks, everything has also transferred over to these time frames as well. So it's real handy for just not getting lost. If you make a notation somewhere, you want to be able to see it wherever you're looking. So on the higher time frames, I wouldn't know about these minor levels of liquidity, So if I'm looking at the day chart, I can see where price might not necessarily make a day high, but it's making intermediate highs as it works its way up or down. So just a neat feature of TradingView. I, I wouldn't recommend not using it, especially with just the other software packs that I have. It's just not as complete. So you try to do everything you can to get your little edge, and if it's just, information is pretty much power in this game. So the more information you have, the better decisions you can make. And it looks like, so I saw this level of liquidity get taken right here. I had it drawn out. And part of this simple model is just to wait for these liquidity grabs to be taken and then look for entry criteria. So on the 5-minute chart, there's no entry, but over here on the 1-minute chart, this is why we dial down into the 1-minute chart, plenty of entries, okay? If you only trade the 5-minute chart, you're not going to get as many entries. You'll get strong entries when the model does appear and you get your break of structure, fair value gap, all of that, and you take it on a 5-minute chart. It's solid, but you'll take a lot less trades. And for me, when I do the math and in the back testing, it just makes sense for me to be on the 1-minute chart. I'll also watch the 5-minute and take a trade on that as well, and maybe add to a position, because a 5-minute may be created after the 1-minute, and it's just another good time to add a trade, add some position. So the liquidity was taken, and you can always argue where your very minimal breaks of structure are, but I like to use the swings. This isn't really a swing. This is a swing. So you got a tall candle or a wick, and then a lower one on both sides. So we call that a swing. It's a break of structure, not a market structure shift. But we trade off of breaks of structure, so I would have had this marked, and I would have looked for a candle to break that with a body, not just a wick. So as soon as that body broke this level, I'm looking for this fair value gap right here to be tapped. And I always add a tick to the fair value gap, so my fair value gap would have been just one tick higher. So if that's 22, I'd have went to 22.25, and that would have been the point that I was looking for. If you do that, you'll enter a lot of trades that normally would have ran away from you, and you'll make a lot more money. So on this trade, if I would have taken it, it would have been an easy 4.75 points, so almost 5 points. And that's kind of a weird, if I set my target there and it gets to here and doesn't hit and then drops, I'd probably just get out and take my money right here. Just have to see, when it's that close to 5, and that's sort of the personal preference, how you handle the managing of the trade. The entry model is the easy part. Where it gets a little more difficult is trying to manage it and capture as much of the move as you can. So that's where a lot of the money is determining how you're going to handle your targets, where you're going to take your partials, how far it has to come back before you get out of the trade, things like that. That's all stuff you have to do through trading. I mean, you have to take a lot of trades and you start getting a feel for that. So I encourage you to either paper trade or trade 1 micro, something to have a little skin in the game. And just when you see the entry model, take the trade. Don't hesitate, just take the trade. And because you can outguess yourself, you can trick yourself. That's why we try to make this mechanical, so as mechanical as possible. So I've got rules up here. I'm going to be trading 2 variations of what we teach here. One is a classic. I'm calling it classic and advanced. So pretty much the silver bullet is this classic entry, based on these criteria right here. The rate on liquidity is this. We rated a liquidity level. Then next is displacement. A powerful, energetic move, especially if there's one big huge candle and another one right behind it, there's no wick. That's a really bullish signal. That means the market is moving. So we put these signals together. We've got 1 signal, we've got the break of structure, 2 signals, we've got displacement, 3 signals, We've got a fair value gap, 4 signals. We get a fair value gap tap, 5 signals. If you get those 5 signals, you've got no excuse not to take the trade. You have to get in the mindset of when this happens, you take the trade. You're a robot. There's nothing better that can happen for you right here. There's no reason not to take it. You might still lose. I mean, none of these win 100% of the time, but you'll develop some discipline and some faith in your setup if you get in there and just take them, and then you build some data. Okay, I didn't hesitate 20 times. I took all the trades. I won 14 of them. Hey, yeah, you lost 6, but you won 14, right? And those are really low odds for even what we're doing here. It's generally more than that, because you're kind of stacking your confluences together to where, if you take out 1 or 2 of those, it's not as strong of a trade. But if you get all of them, that's what we call A plus. And your A plus setup is the one that you take no matter what. I tell people, if you've already taken 5 trades that day, and some of them were A plus, some of them were, scalping or DRIDR, and someone tells you there should be like a 3 to 5 trade limit, that's fine. But when you see the A plus, that's the one you're testing. That's the one you've got confidence in. That's the setup that more times than not is going to win. And if you don't take that setup, then you're hurting your odds overall. You're taking subpar setups and then passing on your good one. So I'm going to try to model that in this live trading. When I see the setup, I'm just going to click buy, and then I'm going to manage it, and I'm going to do the best I can to set good stop losses, good partials, good final targets. And that part of it is your ability to manage it, and that's what you get through repetition. The model that we give you, it's the easy part, really. You just kind of check off a few boxes, and when those boxes are checked off, that's a trade. The rest of it is kind of feel, understanding, the character of each candle, where you're at in your higher time frames to determine what your targets are going to be. There's a lot more that you have to think about after you press buy than before you press buy, if that makes sense. We got about 11 minutes. So that's the classic model. If you watch ICT Kraken, his videos are based on the classic model. So he's always going to look for the rate on liquidity. And this is just ICT 101 right here, except for this part. I added this, but this will benefit you if you pay attention to that. I can't count how many times I've missed trades because it missed it by 1 tick. So anyway, this is mostly what we're going to focus on. You may see me take these trades, which this is going to be an advanced entry trade where I changed my criteria a little bit, and that's a result of my own personal back testing. So for me, I can take an advanced trade if I see, and there's a little bit of subjectivity here because I'm determining what is enough displacement to allow me to skip a rate on liquidity and potentially a break of structure. So a lot of times you'll get a drop like this, and that doesn't really give you a swing. It'll just be one candle after another candle, no swing, and then you'll get a huge push. Well, technically, it didn't break structure. There was no swing, no candle body closing above a swing point. But what I found is that those are still really high probability trades, and I'll win more than I'll lose by taking them. And that's really all I'm looking for, is just an edge. I want, more than 51%, obviously. But if you can get just a little over halfway on a 1-to-1 trade, and you take enough of them, that adds up. So it's just like Vegas, 52% wins, a little bit. And if you can get something that wins a little bit, then you just add some size to it, and that becomes your edge. So I might have got we'll see if it pushes up here. We might have got that 5 points. Yeah. So it would have been a 5 point. There's our 5-point trade. However, depending on how much the pullback was, that's something for you guys to decide for yourself, how much you want it to go up before you let it come back. So My standard rule is 3 points. If it goes up 3 points and comes all the way back to my entry, I'm going to take a break even. That's given back enough to where it's a good indication it's coming against you. But there's also a lot of times when it'll dip down and then take off. So I give it 3 points to come back. If it comes back before 3 points is up, I'll let it come all the way back down to my stop loss. So if my stop loss was, say, down here 2 ticks below this line, and price only went up 1.5 points and came back, I'm going to give it the full distance. If it goes above 3 points, to me that's 3 to 5 points is what I'm shooting for. So that was a winning trade, and I don't want a winning trade to become a losing trade. So if I have a 5-point stop loss and I went up 3 points and it comes all the way back to my entry, I've still got 5 points here to lose, and I'm not gonna allow that. So again, some subjectivity there for you guys. You need to back test. Everything I do comes as a result from back testing. So I identified that for myself, 3 points is a valid actual stop loss. This would be the stop loss I used to get to the swing point where I was most comfortable. That's how much it took me. So on this one, I would have been a little uncomfortable because I needed 550 to get to that point. On this one, I needed 650. The trade won, but whether or not I would have taken it under normal circumstances, I might have went to micros and made it a 3.25 stop loss if I went 5 micros. And I make less if I win, but I lose less if I lose, and that needs to be the priority. Preserving capital is rule number 1. So when I talk about different numbers and kind of give you figures and what my goals are, it's based on what I've already done over time, and this is a very small sample of what I've done, but I like to use it because this is the one that got me excited about this particular model that we're trading right now. When I did this, I realized I didn't need anything else. I don't need support, resistance, DR. I don't need anything. If this hits even a portion of this, and I put a little size with it, and I use multiple accounts, I can just trade this, and it's fine. So I can really master one thing, and that's what I try to encourage people to do. If you try to be a jack of all trades, you're going to be a master of none. And in this business, you have to master something. Okay, so good push. This would have been a really nice trade. So hopefully I'll just be able to show you one example after another of this winning. Here was another win. You could have taken this on a market structure shift right here. I'll count that even though it's not a swing. It's enough displacement to count. And then here's another fair value gap. Here's a retest. Here's another opportunity to retest. And that's something you always want to keep in mind is when you come back to these fair value gaps, a lot of times you'll get a second chance to either get in. Hello, Anna. You'll get chances to get back in, and you have to fight the urge to think that price is going against you here. This is part of the market's normal move, is to pull back and retrace. So a retracement doesn't mean it's going all the way back, especially if you've been in a pattern that's been in your favor, been in your direction. You need to expect these and you need to plan for them. When you see it coming back against you, you start looking for your PD arrays and say, okay, price is reversing, but there's support right here. I know this is an area that price will react to, so let's see what happens. And after you do this enough times, this is a place where you actually say, oh good, it's coming back. Maybe I can get in again and double my position, and then it takes off. And the reason for that is it's trying to shake traders out who went long. So the market is, and I say the market, but we're talking about everybody that's involved in moving the market that makes money off of us in the market. Their goal is to get you out of the trade, take your money, and then they're going to push the market in its intended direction. So you have to anticipate this move. You're going to see this all the time. It's not a bad thing. Yes, sometimes it will go against you and stop you out, but it's also part of what we expect. So, and now it's going up here. So we've got another level here. We've got semi-equal highs up in here. So taking the trade down here would have been, I got 4 minutes, so 5 points. We would have taken a partial right here at 5 points. I would have, maybe I would have came up here to this level of liquidity. You'd want to try to make sure you're targeting a level of liquidity. So if your 5 points comes into the middle of a candle or something, and you're probably, you could get this right here, because if it goes this far, it's going to go this far. So target the levels, get somewhere close to your desired. So a partial would have been set right here. As soon as I got in, I would have created an order, and it would have been sitting here waiting. I wouldn't have had to do anything. And then I would have also created my next order up here at the next level of liquidity. So you make the trade, you buy. First thing you do is you set your stop loss, then go up. You'll set another order for your take profit. You'll set another order for your final terminus of the trade, the end, and then you just sit back and watch. And you know, it's sort of a, you want it to be a set it and forget it. That's why we kind of follow this pattern. All right, couple minutes. So where's it going to go? This could be, when it's this close to an event like this, you don't want to try to jump in. I would have got in earlier, but nothing that's happened within the last 10 or 15 minutes could have got me into the market, because the trade could take that long, and then it's going to run me right into the release. How do I mute all this beeping from people coming in and out? I'll have to get with my resident Discord expert, because it's irritating. But anyway, we'll watch and see how much liquidity it takes. We'll watch and see where it turns around at, and see if any of these levels serve as points for the market to turn on. There's plenty of targets down here. Let me make sure I'm on my right screen for ordering. Yes. Set up to order 2 micros, and then set partials and runners. So here we go, 1 minute. Sometimes it'll go off the screen. I mean, it's just crazy. It's going to whip through a whole bunch of this stuff here in a second. I say that, I hope it's not anticlimactic, but like I said, normally this is what it'll do. And it's going to make a big push, and then it's going to make a reverse push. We're going to get a sweep, and we just wait for that to play out. It could be an hour before we get a trade opportunity. And just have to kind of see. A lot of times on NFP day, the afternoon is really, really good. There you go. Okay, that's why you don't want to try to guess, because everybody on both sides just got trashed. Wherever their stop loss was, unless they were a ridiculous amount away, they just lost all their money. So if I show it to you on this screen, this is the screen I'd be buying on. So this is the stop hunt. Immediate, took liquidity out, looking for a good push. And it could just go on, and you know what you see today is indicative of sort of the pattern that it's always going to do, but it changes just enough to where you can't put your finger on what it's going to do. So it could just take off, and you're going to be thinking, well, gee, Mark, you could have taken that trade and got in on that whatever. But I've seen it so many times show you that same thing, show you the fake, and then turn around and rip to the other side. So this is where they make a lot of money, manipulating the market. And I don't know what the news is. I stopped looking to see if it's good or bad. It doesn't really matter, because the market's going to go the direction they desire to push it, and there will always be a justification. If it doesn't move as far as we think it should have, then they say, well, that news was priced in already, so that's why it didn't move. So it's for them to say why it did something or why it didn't. So it's better to just read the price action and trade the price action. Trade what's on the screen, not what the analysts say, not what your friend says, not what the news says. You're looking for what happens on the screen using the information that you've compiled and the preparation that you put into the day to, to find your setups when they come. So that wasn't terrible. It was a 21 to, so it was a 15-point move on a minute candle, which that's $750 if you got a contract. if you'd have been able to pick it up down there. Well, let's see what it tapped into. So it came down here and it tapped liquidity below the body close of this candle. So that's no longer a level of liquidity. I get rid of that. Went all the way up here and tapped through this level of liquidity. Took these equal highs out. And now we see what what happens. It's looking bullish right now, I think, because of the size of the stop hunt this way, but it just doesn't mean anything yet. I mean, we can, kind of guess and assume about what we think might be going on or happening, but we really just don't know. Anybody have any questions on this? Addy, if you go over here and you click plus, oh, you click this one here. You click the hold on a second. Let me show that over here. So you're clicking on this little gear icon right here, and then you can select your columns and draw them over, and whatever columns you want, that's what shows up right here. And there's a ton of stuff you can do with Trade-A-Bait as far as what you can view and what you can see going on. All right, Frank, I got you back on. What's that? Okay. All right, so on the minute time frame here, we've maybe creating a fair value gap to the downside, but there's nothing to really pay attention to. We're not looking for anything really until we get up here or down here now. So everything that happens in the middle is just noise. We created a new intermediate high and low. So for me, I need to see one of these broken as an indicator that the market chose a final direction. And even then, it could, through the course of the day, this can be a huge sweep back and forth. So you really have to be careful. I'm expecting it to take out one side, and before the day is over, to have taken out possibly the other side. That's just what I see often, and I want to kind of plan for that. So I won't get too crazy if it does dip through here. Yeah, everything's a little bit more measured on a day like this. It has to be a really strong setup, and you want to make sure you're not getting faked out. Yeah, search and destroy day. So if we go look at the sort of, I'll put it on a 10-minute. So highs and lows from Asia taken out by London, and then it wouldn't be surprising to see these highs and lows be taken out by New York, and we call that a search and destroy day. It's really good when it's really tight consolidation right here. This is not as good, but when it's really tight and just even and goes straight across, and then you get to New York, the back and forth is there's moves both ways. So once it starts taking out the top side, then you start looking for your downside trade. Any questions? Okay, so now we get to push more liquidity taken. So we delete these. Tapped into a fair value gap. This is the market's opportunity to make a lot of ground. So, you know, when it gets several days or, of liquidity going in one way, then all that gets picked up on a move like this. And we tapped into this fair value gap right here. We'll see where this candle closes. 2 minutes left on that one, so I'm going to go back to the minute and kind of see. So we're pulling back up. And see, that kind of tells you. So I was looking at this saying, well, we got a good sweep here. It looks bullish. And the next thing you know, it whipsaws the other way. So it knows what we are thinking might happen, and it plays against that. They have people who are PhDs who sit in rooms and do focus groups and studies, and they show them trades and market activity, and they record their responses, and it all goes into a computer, and it's all AI, um, calculated to try to use our psychology against us. I mean, if you don't think that's true, think what you would do if you had control of the market like they do. That's exactly what you would do. That's exactly what I would do. How can I make the most money off these people? And that's why a lot of times, if you don't approach it with that mindset, you'll feel like the market has your number. And if you've ever traded just, standard retail strategies, and you're trying to do certain breakouts or patterns and things like that, a lot of times you're going to get in and you're going to think, why? It's like as soon as I made a decision to buy, and there's even memes about it, funny ones that show, a chart with a big push one way, and, this is what I do when I don't buy, and then a big push the other way, and it's like, that's what happens when I do buy. Yeah, that's by design. They want to shake you out of the market, and then they're going to take it to a different level that you would have been in on if you didn't get scared or didn't get stopped out. So that's why we always anticipate the false move, or the move in the counter direction. And it's even got a name. I mean, it's the Judas swing, I guess. They named it after Judas because it's a traitorous move, right? When it comes up like this and you're thinking, oh, I'm going to go long. Look at this big, bam, I'm taking this all the way to the house. And then it does this to you. That's by design. And then all the people that got in here, they're like, okay, we're not going to go for that fake, ha ha ha. We're going to go short. Oh, well, then you'll get one of these, and everybody gets trapped. That's why we're just kind of waiting right now. For those that missed it, just got a couple different trading models that we're going to follow based on the silver bullet, based on what we're trying to show you guys here that haven't traded at all, or have some experience but are trying to find something more probable, more repeatable. Classic rules. This is straight silver bullet. With this one I added, that's about it though, but these are all the things that you want to be looking for. The discount premium portion of it is just pulling a fib and looking at your price leg. So when you pull a fib, you're in a price leg from high to low. You look at the 50% line. Everything down here is discount. Everything up here is premium. If you're going the opposite direction, then this becomes discount and this becomes premium. So if we're looking at longs, we want to be in the discount area. You don't want to discount. You don't want to try to go long up here in premium because you have less distance to where the market's probably going to turn around anyway. So these are just some of the standard rules that increase your odds of winning if you follow them, and help make it a mechanical approach. That way we're not guessing like, am I too high? Am I too low? Did it get away from me? You just use the 50%. And then there's also another area that is called an optimal trade entry, which is just OTE, which is up here between 70, 50, and 79 somewhere. This is a normal area of retracement against the current price leg before we can expect it to turn back around. So this is, I guess you would just say this is the market going back to capture a bunch of liquidity and shake a bunch of people out before it can then turn around and make a big push the other direction. So Shannon, got any questions? Anna, Paradise,
Mm-hmm.
we're good. Okay. I don't know who's just shy, or if don't be shy. If you got questions, just blurt them out. I mean, like I said, we're anticipating that most of you are new and have little knowledge, so nobody's going to be surprised if you say, "What's a fair value gap?" or "Show me what an order block is," or whatever. So we had no closes above any of these fair value gaps. So lots of wick activity, but technically we would say that these fair value gaps have been respected. So they did show, a level of resistance because we didn't get a close above them. But again, because this is NFP, we always expect the big wicks to go up. And ICT says that the bodies tell the story and the wicks do the damage. If you're trying to place your stop loss somewhere, don't place it on where you think the candle's going to close. Place it on how far you think it could reach to. Sometimes if I'm anticipating a really big move, I will pull my stop loss down temporarily quite a bit to anticipate this move, because I see it so many times. If I just try to sit right here and catch a big move, well, a lot of times this is going to come down first and knock you out. So if I'm feeling like it's bullish, I'll expect the push. I'll pull my stop loss down here. And you have to have a really good idea that it is bullish, because if you pull it down here and it's bearish, then you end up losing more money because you pulled your stop loss down. So it's something you have to kind of get comfortable with yourself. So we didn't even we didn't make it to London's open price yet. These are other levels that can be paid attention to, but since they're inside of a fair value gap, I'm not going to confuse you guys with DR stuff. I was just curious what those levels were. So on higher time frames, if you look at the higher time frames, you can see that on every one of them, our eventual drop down here was into something, right? On each case, we dropped into a level. Maybe not this one. Yeah. On every case, we dropped into a level that we had pre-marked, that we were looking for reaction to price. And this should give you confidence about the strength of these levels. Ryuk, I can hear something on your screen. I don't know if you're trying to talk or not, but if you are, we're not getting it. Okay. What's that? Yeah, I'm gonna let you work that out for a minute. And yeah, I'll check on you in a few minutes. You're welcome, B, or Anna. And welcome, Paradise. Anyway, because we approach the market with the idea that it's not random, that there's levels that the market refers back to, reprices to, seeks to fill from periods before that were not delivered accurately or efficiently, that I get a lot of confidence from that, because when I was just trading, before I learned about this approach, I had nothing to really guide me. I kind of knew what levels of support and resistance look like, but some of these are stronger than others because of the fair value gaps in the order blocks. You can get the same type of area where price stopped, but if there's no fair value gaps or order blocks or anything in this area, your expectation isn't as strong that it's going to come back and stop. But since we do have a fair value gap here, that adds to our ability to say, hey, I'm going to pay attention to this area. I'm going to have a trade plan based on what happens when price gets down here. I wouldn't do it on a day like today, but a lot of times if I see a fair value gap like this and I see price getting close to it, I'll say, okay, if it makes it halfway into the fair value gap, I'm going to take my trade for a reversal. I'm going to put my stop loss 2 ticks below that. And that's my plan as I'm watching price come down into this area, because I have a high confidence that I'm going to get a reaction and a turnaround. But it also allows me to have a very tight stop. So if I went to the middle of that fair value gap, it's 45.19. Come down here, a 1.75 would be all I would be risking on this type of trade. That's some of my best risk reward type trade right there, because so many times you can count on this type of reaction into these fair value gaps, and you can't always guess the right one. Like if I would have guessed this one for the move, I would have got stopped out. I probably wouldn't have guessed the first one anyway, so this might have been, I could have got a probably crazy trade on this, but I'm not going to start trying to show you guys how to trade the NFP move itself, because that's like suicide if you're not careful. And a lot of people, they have so much leverage in these moves. This is like Vegas on days like this. There's people that know if they go in with a heavy position, it's almost like a roulette wheel. They got a 50-50 chance of hitting it really, really big. And that's such the essence of gambling. And that's some people's, that's their style. They win big, they lose big, they got big money. So, but I'm trying to do this, one way consistently and repeatable, and master that one thing. And in order to do that, I have to get rid of this mindset that this is even an option for me. I won't take these anymore. But I'll definitely high five you guys if you come in and say, hey, I made $2,000 off the NFP move. I'll be like, right on. You did good. So it's always good to have a really, really higher time frame view as well, because sometimes when we run into these times that these macros run, those are pushes towards draws on liquidity that are more external to your current price range. So you don't even see these levels so much on the smaller time frames, but they're up there. How high is that? 45.38. Wait a minute. Yeah, it would be up here somewhere. Not so big on the 15-minute, but if you go up here to these, it's 30 more points, so 69. I don't know why that's not showing up at 69. Let's try to figure this out real quick. Oh, it's not. I don't have it synced in the layout. If I sync it in the layout, then I come back over here, and it should be. I have to tell it all time frames. Well, it's broke. I don't know what's going on with that. Oh, 46. Oh, no wonder. Yeah, that's like, okay. There we go. There it is up here. So on your smaller time frame, you don't see that, and the odds of us hitting something that far away are pretty slim. I'd say completely slim. All right. So one of the good things about trading this way, it takes a lot of pressure off you, off me, because we're just waiting for something that we've already identified as high probability. If this doesn't work, it's nothing you did. It's not your fault. You're not a bad trader. You had a plan. You set it up. It was your best plan. It was, the best chance you had to make money in the market. And a lot of times it's going to run for you and you're going to make money. But you're also going to have times when it just completely tanks, goes the other way, and you get stopped out. You can't let those discourage you. That's part of trading. Um, yeah, I mean, it's just going to happen. So if I follow these rules, and I grade myself on whether or not I followed the rules. So I have a place on my journal where I keep track of, did I follow the plan. Um, I want those to be as many yeses as possible. And then if I follow my plan and it doesn't work, I have no reason to be upset. I have no reason to think, oh, I can't do this. You've got to get the mentality and the psychology of trading through your head, um, in order to be effective. Because if you start having doubts and getting down on yourself and feeling negative, it's going to affect your trading. It's going to affect your ability to pull the trigger on those moves that you would have won, and it can lead to a downward spiral. So follow your rules, get a good trade plan that is, like I said, high probability, and then you just follow that. And if you don't get it, then you go to the next trade. That's all you can really do. And over a period of time, if it loses so much that your win rate is terrible, and you're looking back at it and you're saying, okay, I followed all my rules, that's when you refine the process. So that's part of the trading as well, is to gather data, identify what you can change, make incremental gains, small changes. Well, I noticed that I didn't pay attention to that volume imbalance. I should have been looking at that. Okay, so on the trading plan somewhere, you've got something that or in your rules list or in your lesson list or something, you have something that points that out to you, so that next time, and I'll show you what that looks like. Lesson list. Okay, these are things that I thought should have happened that didn't happen, or something that I noticed that was repeatable, something that I apply and add to my toolbox for things that are in the back of my mind. And some of this stuff some stuff I've got written on, index cards, just different ways for me to keep track of it. But enough of this stuff get moving in your direction is momentum, and it's things that you've identified that maybe have caused trades to fail or didn't allow you to make as much as you wanted to or should have or whatever. So you're constantly adding to your plan, constantly adding to your process. And it can be overwhelming at first. I mean, it's a lot of what I just showed you is a ton of information, and I've made mistakes that are even on that list before, and then I went back and highlighted them. I said, okay, it's on the list and you still missed it, you dummy. Let's see, I'm looking at your text here, right? And bringing you back on the stream. Okay. Looking for buy side and if possible, those hour one SIBIs above market price. So he's talking about the hour time frame. So we go over, look at the hour time frame, and buy side, hour one SIBI, sell side inefficiency, sell side, yeah. Those are fancy names for fair value gaps. ICT recently changed them with the 2023 to sell side inefficiency, buy side, I don't even remember now. But yeah, it's always good to have a bird's eye view of what's going on. That's why we do the multiple time frames. So we've got this good push now. We got the big move. We got the fake. And now this is almost classic accumulation, manipulation, distribution type stuff. We accumulated here, prior to the big move. Big push up. Then you get your manipulation. Manipulation is the same as the inducement to take it the other way. And then the market eventually decides which way it's going to go. It's wanting to reach areas of liquidity. It can't waste all day just jumping back and forth right here, because there's no liquidity to be swept. The people that either got a lot of money or they didn't get any money, they're already out of the game. So now it's just people sort of on the sidelines seeing what's going on, and if they're smart, I'm sure there's people that are doing all kinds of things. But when you're looking at it from this point of view, you're have to be careful. You do have a lot of downside room here, but you're also bullish because of the direction of the market and the PD arrays that we're looking at. So right now we're expecting upside until we see something else, like a close below, a fair value gap or something like that. But as of right now, my inclination is that we get some push up, um, and until I see something to change my mind, that's just the bias that I've formed. And that can change in a minute. If this candle comes down here and closes below this fair value gap, then I would recognize, okay, I had an idea based on good knowledge, good fundamentals, but the market's the market. And no matter how well you prepare, no matter how much you got your ducks in a row and you crossed your T's and dotted your I's, there's going to be days when it just doesn't work out. And that's why it's a probabilities and a numbers game, to try to position ourselves to take advantage of what we've identified as a high probability setup, and we take that when we see it, recognizing that it's not going to be 100%. So if you get anything out of it, I want you to just keep that in your mind, that the trade plan is important, having your rules is paramount, and if you do that, you judge yourself on how you followed your rules. Okay, that'll take a lot of the bad feeling away when you lose trades. If I lost 5 trades today and I followed my rules on every one of them, I'd have no reason to feel bad, other than I didn't make money. But as far as me as a trader personally, if I followed my rules, because not everybody can follow rules. You'll find that out when you try to follow them. You're going to make rules and you're going to break them, and you're going to how often you do that and how long it takes you to finally decide that you do yourself more harm than good when you break your rules, that's something every individual trader has to deal with, overcome, figure out how to master. It's you against you here. It's not you against the market. It's not you against other traders. It's not you against Twitter. When you're sitting in your computer and you're watching the market and you're trying to make these decisions, it's your emotions that you're battling. It's your fear and it's your greed that are going to make you do things that aren't always in your best interest. I don't know. That's probably the best way I can say that. People say that the psychology is the bigger part of this, and I agree. Because what I'm showing you here is, if you think about it, if you do this for a month or 2 or 3, this will be so second nature to you. You'll be pulling the trigger on trades left and right, and after that, it's how well you do with the string of losses that you get, how well you deal with having huge days that just you can't believe you made that much money, and then you get in the next day and you're like, well, I made $5,000 yesterday, and you get cocky and you start deviating from your rules because you want to leverage that into a bigger gain or whatever. There's tons of different reasons why you get away from your plan and don't follow your rules. So each one of you will have to kind of figure that out. That's why it's a good idea to journal. And I show this stuff a lot because I don't know who all's seen it. I mean, this is what's important to me as far as working out what I do, what I'm thinking, how I feel, reflection, find out, what was on your mind when you had this bad day, if there was something going on, and be aware of your mindset as you're trading. If you're hungry, tired, angry, anything like that, and you go into a trading day and you blow up, you need to record that. You need to say, you know what, I look back and I saw on that day I didn't eat or I didn't sleep or my significant other was on my ass, and then you write that down. And next time that happens, you go into trading aware of that. Last time I was distracted. Last time, or you know what, I had a bad day when I didn't eat. I'm gonna grab a muffin. Whatever it is. Everything you can do to improve your chances increases your edge, and your edge is everything. So you have to take everything into consideration, from preparation, your trade plan, your mindset, your mentality, where you're at. You put all that together and you refine it over time, and you build it up into your process. The way you approach this. And the more serious you take it, the more detailed you'll be, the more dedicated you'll be. You'll go to bed earlier. You'll do the things you need to do to make sure you're sharp. You'll make sure your preparation's on point. Because if your preparation isn't on point and you get in here and then you look back, you go to review your trade, mark your data down, and you're like, oh, I didn't mark my upper liquidity. I didn't think it would go that high. Well, there you go. I mean, you need to be aware of everything. And like I said, how important you take this, how much emphasis you put on the details is going to have a lot to say about, your probability for success. and it's different for everybody. I mean, but I think we just want to put ourselves in the best place to win. So some consolidation at the top here. We took out this liquidity here. Right now the market's favoring this direction. But honestly, in my mind, for like the end of the day, I was kind of bearish when I was looking at the higher time frame stuff, especially the 4-hour. So if we go back and kind of look at what I saw, so this is a 4-hour time frame. Each candle represents 4 hours of back and forth, back and forth, back and forth. These are much weightier signals as you're trying to understand where the market's going to go. As smaller scalpers or day traders, we can make a lot of money even if it's bullish, catching down moves, because some of these down moves will be like, that's from 80 to 52. So here's a 28-point push down. Even though the market's bullish, I could have taken 5 of my trades back to back and never would have got turned around. Okay. Now there's a lot of retracement in there that might have stopped me out, but I'm just saying this is a good idea to sort of have an understanding, a bias of which direction you're most likely to do best in, but at the same time recognizing that you can still trade either way because you're a day trader. So that's one of the benefits of day trading. People who are investing in swing trading, longer term stuff, they don't have that same flexibility that we have to move both ways like that. If they bought down here, all they can pretty much do is wait till it starts going the other way, you know. So I did see a market structure shift here on the 4-hour, so that reversed my bias from bullish to bearish. And the way I determined it was a market structure shift was I had a prominent swing low. At this point, this would have been a prominent swing low before this, and it never was broached. It was never broken. But from this point, we went up. We broke this high, which made this a protected low. So this is a place, since it broke this high, this was an energetic area for price to propel from. There was a lot of money to push it above this high. If you have resistance on both ends, you know, there's sellers up here, profit takers up here, you know, to some degree that the market still works on that principle, but eventually, or overall, it's, you know, where the algorithm's pushing it. So, and if you want to look at it from that perspective, it's the market, it's the algorithm saying, I want to go higher, and I'm going to violate this top to do it. So this becomes our validated low. So when you pull it across, if this low gets a body close below it, that's a strong signal that the market could be turning and now making a move, you know, for sell side liquidity, or, you know, for whatever reasons. This is part of the natural cycle of the market. When it went up here and came down here, the reason I used this one and not this one is because from this point, the move did not create a new high. So again, you're looking at the energy from the low point to the high point. If it does make a new high, then this becomes the protected low. This is the low I'd need to see broken with a body close to tell me that the market might be headed in the other direction. But since it didn't take that high out, I go back to the last time when there was the move with the high being taken out from the low. And we're going to put some good market structure videos up that will help you. You really need to get good at that and go through and make that part of your, you know, routine to learn and understand things. Market structure is, I can't say enough about how important that is, because what we see on higher time frame market structure repeats on lower time frame market structure. It's just not as dependable on the higher time frames because of the, you know, the amount of time involved for each one of these candles to form. It makes it a more significant event when it breaks on a higher time frame. So if it did this on a minute chart, I wouldn't really consider it much of a big deal, or a 5-minute, you know, 10-minute, whatever. But on a 4-hour chart, this is significant. So I'm really expecting us to come up into some sort of a PDA array here, depending on how high. I mean, it could go, you know, it could go all the way up to here. It still wouldn't be an invalid market structure shift, because you have a higher high, a lower high, and we would expect another potential lower high. We just don't know where it's going to be from this range to this range. You're going to get another lower high, Um, and we're just in the process of waiting to see that. But since this is a 4-hour chart, this fair value gap, the distance we're talking about is from 45 to 59. So this is a 15-point fair value gap. That's pretty sizable. I wouldn't anticipate us uh, going through that. But again, that's just my feelings until it changes because of what I see in price. It's nothing wrong with forming an idea, forming an opinion. It doesn't mean if it blows through here and goes to this one, it doesn't mean I was wrong. It meant I was taking the first step in my idea to anticipate where price was going to go. This is the first bar you have to cross in order to get me to think something else. If it doesn't cross this bar, I'm bearish. If it crosses this bar, okay, now I'm expecting maybe to see if it reacts off the next fair value gap. Price generally moves between imbalance to imbalance, level of liquidity to level of liquidity. It'd be surprising if it just went right here and turned around for no reason. But then if you went to another time frame, you would see that what it actually hit was a different time frame PD array. But it still reacted in a PD array. These are PD arrays. Every fair value gap, order block, every kind of block, there's 50 of them. That's just sort of the thought process. And up at the top you usually have your order block. And for those that don't know, the order block is the last candle in the opposite direction before a big push. So this is the last up candle before a huge push that created fair value gaps. So that makes this an order block. And I've got an indicator, and it's in the tools channel that will show you how to program your trading view to set up this exact indicator. It's free. And they're good to have on the charts, because if it breaks through this and breaks through this, I'm still looking for an opportunity to get into a trade short. To me, it hasn't confirmed bullish completely until it breaks the uppermost PD array. This is another level of resistance that price can turn around in, so you've got to take it into consideration. And if you get a order block on top of a fair value gap, that's really solid. You go down into the minute time frame and you're looking for a model that we have using these criteria to form inside of this window. So in here somewhere we would find a a breakup structure, a fair value gap, some displacement coming down the other way, create a new fair value gap, and we would get in on it. And that's how you keep a tighter stop loss, because if you try to put a stop loss in here, you're going to go way over 5 points. But when you zero down into here, you'll be able to see it a little bit differently and manage your risk better. So respecting this fair value gap, nobody closed yet. Strengthens my opinion that we're bearish for the moment. So bullish, now bearish, because we're respecting this PD array up here. We reacted off of one PD array, now we're reacting off another one. The reaction on this PD array was bullish. Well, we didn't just blow right through it. So at this moment, my reaction is we've had 3 rejections out of this fair value gap. If it turns around and gives me displacement and breaks a structure here and creates a new fair value gap, for me that's enough to take the trade. Even though we had all this move here, then you get a counter move that sort of negates what you had here. And it negates it by giving you the same signals basically that told you this was strong. Well, now you've got strong going the other way. At some point you have to have the rules, because you'll get analysis paralysis is what they call it. So you could say, well, I'm scared to go short right here because I got these fair value gaps right here. Well, you don't know what's going to happen when price hits these. All you can do is what price is doing right now, and if price shows you the signal that tells you more than likely you've got to move, you've got to act on it. That's just how you get consistency, and doing the same thing over and over, and then you trust because you see how it plays out. And that's what backtesting is too. You develop trust by going through and creating these scenarios by backing up in time, right? We back up, we play it forward, and we watch what price does, and then we make notes and we say, okay, in this situation I got between these 2 fair value gaps, and the signal was valid. I got my entry model, and we went all the way down here and took out liquidity. So you make notes of that, and you get percentages, and you say more often than not, when I get a counter signal, even in the bullish move, that's enough to take a trade and feel good about it. I'm doing a lot of talking. Got to be some questions. Okay. So if you've heard me before talk about areas of consolidation, once it starts going sideways, I like to just make a box. Kind of get the range. In the retail world, this is a flag or a pennant. It's a trade pattern. And what people will look to do is catch the breakout because they see this as an area of resistance. Price keeps going up, 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 touching this line. So they'll have a trend line up here, or they'll have the actual box. And when price breaks out above that, they have a limit order setting here, and it'll take them into the trade, and they're hoping for an extension up into here somewhere. Well, the problem with that is that the market makers know that when you see this pattern on a chart, several thousand of you, or 500,000, or however many, are going to take that same trade. So more often than not, the market is going to give you that in. It's going to want you to put your money into the market, and then it's going to turn around, and it's going to turn against you, and it's going to stop you out. That's why when we see this right here, we anticipate a fake move first. We don't take a breakout because, like I said, more often than not, this will get swept both sides. So if the market wants to go down here somewhere, it's going to reach up here. It's going to pop up to about here. It's going to take out the people here that were sitting here short with their stop loss, a point above these wicks. If the market pulls through that, then their shares become the market shares. They're able to buy those at a discount. If you're up here and you're about to go short, this is cheap, to be able to buy your shares. So, and then it would come down here. It would make its move down. And then on the other side of that, it can go both ways, because you've also got people down here who are long. They're expecting a continuation. They're just trying to buy the dip, is what that's called. Buy the dip, and eventually they're hoping it turns this way. Well, the people that push the market also know that. So there's a whole lot of people down here long, and they know that if they push price down through here, they will be able to accumulate all of these shares. And they need our shares to be able to make money. If they don't have any shares, then when they get up here, they have nothing to sell. Or when they get down here, they have nothing to sell. So the whole goal of this is to acquire liquidity from the market through these periods of consolidation, create fake opportunities and inducements to get injections of liquidity into the market that they can then turn against and capitalize on. So that's ICT 101. And when I learned that, when I learned that, it just changed everything for me. Because like I said, I felt like the market had my number, and I was frustrated, and it felt very, very just no confidence. It felt like 50-50, like guessing, and it is sort of 50-50 proposition. You never know. There's times when this breakout will work, and that's just enough to keep the breakout traders, right? If it lets them win 30-40% of the time, and then crushes them the other 60-70% of the time, that's winning for the market. They don't need to win all the time, and they don't want us to all say, screw this, I'm going to go put my money in a mutual fund. They want us right here. So we get up here, there's no way to tell how many times you're going to get these taps. So you wait, you get your breakout. This could be an opportunity for us to raise our box a little bit, or this could be the place where the market turns around and goes the other way. But since it broke our box, we're kind of anticipated that. It's also still in a PD array here on both time frames. So now we get possible, there's liquidity down here. And that's just what you look for. Hey Jake, glad you could make it.
Yes, sir. How you doing today?
I'm doing good. It's doing exactly what I've, kind of anticipated it doing so far. I'm just waiting for some stabilization and an actual move that I can get in on. I told everybody I've kind of got the rules up here for just the classic and the advanced entries, and I'm focusing on the classic entries while we're teaching new people. Not to say I won't, because I'm still trying to make money too, but I'm going to let them know this is not exactly what we're showing you. It's a little bit different. But I've got the levels of liquidity drawn out, and I'm waiting for reactions off of those.
Saturday, I got stuck between upper 1 minute fair value gap and probably nothing's going to happen till probably 9:30. We'll see if we get some volume into it. So,
Yep, waiting to see. But this sets up for some really nice moves later in the day, um, because once it takes a side, and then you get up here and kind of does the same thing, starts just hesitating to go much higher. It's really just looking for a spot to sort of turn around. It'll give you some fakes to again draw people in, because we're all anticipating the reversal. That's what we do. Some people trade trends, some people trade reversals. So the market's trying to take advantage of both of us by reversing on the people that are trending, and then faking the people that are waiting on the reversal. So once I get up here, I'm really anticipating, really waiting for that move down, but I also know there's going to be a couple opportunities to get trapped. And up here is sometimes where I'll wait for, I'll kind of hope for the 5 minute to also confirm my move. I've gotten spanked a couple times trying to take the first move, even with a break of structure, and it comes back against me. And I didn't go very high. If I'd have been a little more, with my stop loss, I might have could have stayed under it. But you can't trade like that, putting your stop way up high, hoping that it is enough to catch the reversal. It works until it doesn't, and I guess it's a bad practice to have confirmed for you. You don't want that reinforced too many times, because then it's harder to stop doing it. And I've got some of those tendencies that I still, you remember the times you won on it, but you don't remember how many times you lost until you get crushed a couple times, and then it leaves a more lasting impression. So I kind of got to that point with some of my scalping methods. I did really good a lot of times on it, and there was just a couple times where I went on tilt, because it didn't work, or I moved my stuff and it still didn't work, and I got stopped out way up here, and I was like, man, I'm gonna get that back, and that's just, one bad move after another. And none of us are immune to it. The best in the world aren't immune to it. Anybody that says they are, I wouldn't take them seriously. That's why, again, following the rules. Those aren't in my rules. I shouldn't be doing those things, and they're not in my rules for a reason, because I've identified that it's, more often than not, can be a losing proposition. When you win, you'll win okay, but when you lose, you get your ass tore up, and it doesn't balance out. It just doesn't. So winning 20 times, you get that dopamine hit. I'm a winner, I'm a winner, I'm a winner, and then the one time you lose, you lose your appetite for the day, and you can't sleep that night. How do I know that? Well, I've done this, so. And I'm going to tell you guys, and you're going to do it anyway, just like people told me, and I did it anyway. So we all have to learn our lessons at our own pace and adapt it to our practice. I'm a little more focused on the warnings that I had. I wish I'd have taken them sooner. I'm pretty much have been a victim of all the rules that I broke them now. So it's not like, oh, I'm going to start following all the rules. And, no, it's cost me, quite a bit because I didn't listen to other people and thought I was different and better and, sharper. No, I'm not.
The market is
I could barely hear you.
said the market is always correct. The
Market
market
is
is
always
always
correct. Yep.
What do you
And
have,
go
Mark?
ahead.
What do you have as a level up top that you would be looking for it to go to? I mean, I got yesterday's previous high up there, and I got a level as far as the high of today since midnight, both around 45, 47. Is that an area that
Yes.
you got, Mark?
Yes. Yep. 45, 47. I don't put what they are anymore. I just know, if I've got a dotted red line there, that's an area of liquidity that's important. Um, I I have a hard time going back and marking them all, and I'm trying to save time for. Um, I don't multitask that well, so I spend 30, 40 minutes pre-market. I get them all marked up, and then kind of look. And I was showing them there's stuff, as high as you want to go. There's there's areas of liquidity and targets up there, but these are the ones I think are within striking distance. That if we hit, I would uh, look for its turnaround on that. So we're kind of in no man's land right here, on the time frames. We're not in any PD arrays. Um, Coming up on some previous DR/IDR levels. There's yesterday or London's open price, and then DR/IDR, and then we're in an order block. We're right in the middle of a 30-minute order block, and if just for an exercise, you always want to practice fibbing your PD arrays to see where the consequent encroachment is. That's close. And then that's just, I'm looking for a body close over this 50% mark to tell me yes or no on this 30-minute order block. If it body closes above the consequent encroachment, it doesn't mean it's going to the top. It just means that now my bias has changed as far as the distance from here to here is more likely. If you get a couple wick rejections from this point, then my right now bias is for us to bounce out of this order block. So, and using different time frames, that can be a little confusing, but like I said, you kind of pay attention to the higher time frames where that's concerned. Have that, foremost in your mind, but you're also paying attention to what's going on here too. Because we are in a, if you did the same thing here and you fibbed this fair value gap, I'm going to use my other fib, 50% fib. If you fib this fair value gap, you'll see there's no body closes below it. So this fair value gap right now is holding, but this one up here is also holding. So that's why we have consolidation. Isn't that amazing how, if you didn't have any of this stuff on here and you were looking at the charts, and this is how I was in the beginning, trying to make sense of this stuff, right? That's all you're looking at. And if you don't have this here either, you don't have a clue why this is doing this, right? You can put your trend lines here, but all that is showing you where price went to. It doesn't tell you anything about an expectation of why, or some of these you would have started down here and they would have got popped through, and that invalidates this one. But when you're looking at this kind of information and you're even splitting it in half, you're really narrowing down what's going on. So here we get our box broke. What happened to my box? Oh well. I'll put that back. We had a box that was right here and right here. I think I was more like this. Something like that. So I expected this. You heard me say that that you get to break out the inducement up through the range of consolidation. Don't ever take that. Wait, because this is oftentimes, and I know I talk about this every time in the videos, and it seems like every time it does this. So if that doesn't give you some confidence that just knowing this right here keeps you out of some trouble if you're trying to take a long, even if you have a PD array down here. We do have a PD array down here, but we also got faked deep enough to where you would have seriously considered, getting out of that position. Now, lo and behold, what does this one do? This one comes down, sweeps all of this. Now all this liquidity has been taken. And, it's only, well, that's a good little bit. That's more than, I go a couple ticks. So, all the people that are here with tight stop losses, they're out of the trade. And then, is this going to be the initial direction? Is this the accumulation? Is this the manipulation? And then is this going to be the distribution? AMD is a concept you want to get very familiar with because it will help you to anticipate, anticipate moves, keep you out of taking bad trades. And because of our rules up here, we'll never get tricked by any of this stuff anyway. We're not going to take a trade out of consolidation. So all these flag patterns and pennants and, whatever you want to call them, I'm not going to be involved in any of that just because I know it's, a not great high probability trades. There's people, that's all they do, and they make a ton of money, and I'm thrilled for them. But for me personally, it just doesn't line up with the overall context of, how I feel I'm going to be as a trader. So still respecting this and respected this little one in here too. Little baby fair value gap. From here. Wait a minute. Oh, that's an overlap. Okay, that's an overlap of two fair value gaps. So strong area there of resistance. This is really just trashy. It's trashy on ES too, or NQ as well. But it looks like we got some, I don't know, that's about the same. NQ is a little more, looks like it's coming down a little bit more, but I'm looking at the SMT. Very similar move as far as, and liquidity wise, very similar move. They both took out, pretty similar levels of liquidity. So they're in sync, which is good. We can learn something from that if one of them diverges from the other by a great amount. Once you get a swing put in and one of them comes down and takes that swing out, but the other one doesn't, it's a bullish signal on the one that didn't. So most likely it's came down as far as it's going to go. So this one on NQ, it's in a fair value gap on this time frame. This one is not in a fair value gap, so could be bullish for NQ. It might take ES with it, and that's something we'll just kind of be watching for. All right, now we get a nice push here, big push. So I'm looking at this on my Tradeovate screen and planning on taking something if it drops, gets fair value gap, then that's definitely a trade opportunity. But that could be the other side of this, this could be the fake to this side. There's just so much wick right now on these. When you see a displacement candle, you really want it to be, close somewhere down here at the bottom. You don't want to see this right here because this is a bullish push on what's supposed to be a bearish signal. So no, definitely not. Right. Okay. Didn't want to do that. So another fake, took out liquidity. And this looks almost like a more substantial stop hunt than we had here. So it's an indicator that for me right now, the bias is bullish. But that said, I can't, if I'm going to follow classic rules, I can't take this trade because we're way up into the premium for the price leg. So if I fib that out again, you'll see, right, I got my high, I got my low down here. If I'm following classic rules, I can't take a long in this box. I just keep moving the box up until I get a push the other way. So since I'm following classic rules, that's the one I'm going to stick with. All right, so hopefully this made sense, all of this, because this is important right here. You're going to see this more time. You get more of this than you get anything else, and you need to know how to navigate it and what to look for and what to anticipate. So consolidation, liquidity is created top and bottom of the range. Fake right here, pushes above the range, induces people in. Market comes down against them. Same thing, push up, people going long. And then eventually it comes, it sweeps all its liquidity, makes a solid stop hunt, and then it goes in the direction that it always wanted to go from the beginning. Over here, the market knew it was going here. And that's part of the, you know, the market dynamics that ICT really hammers into his, you know, teaching, to get us to know that, believe that, anticipate that. Because when you think like that, then the market makes sense. All of this made sense to me. Nothing was a surprise. You know, I didn't get tricked into anything. It's eventually going to come up here. It's going to hit my targets, and I'm going to take my trade. But from a random perspective, you have no reason to assume these things. If it's random, then it doesn't make sense. I mean, it's just random, you know. And how do you take a trade on something that's perfectly random? You don't have a way to really plan around that. So we take these things like this that we can anticipate certain movements on. We use it to confirm that our understanding of the market is true. We get confidence from that. If what we understand about the market is true, then our understanding of PDA arrays is true. What we understand about levels of liquidity is true. And we can build a really, really strong confidence that the type of trading that we're doing is with the market. We're trading with the market, not against the market, right? Because if I knew that these levels of liquidity were targets, the market has to go reach them, and I'm expecting it. We're in sync right now. We're together. I'm like, good market, good Mr. Market. You're doing exactly what I need you to do. We're working together. And then once these levels of liquidity are taken, then it's, you know, we use that same knowledge to then make judgments about, okay, what are the signs? Is it still bullish? Is it starting to get some consolidation, losing some energy? Now we're waiting for the market to do what the market's going to do, which is target opposing levels of liquidity. And again, we're with the market. When it turns around, it's met our expectations, it validated our signals, everything's green, go, and you know, we take high confidence trades that are high probability. And once you know, are able to execute on that at a fundamental level, all you have to do then is just, you know, get to where you can size up a little bit, maybe play with some multiple accounts, you know, however you want to approach it for your own individual trading, and your stuff gets supercharged, and pretty soon you know, don't know what to do with all the money. That's the way I'm going to present it anyway, because that's how I feel about it. So now we're just bullish as heck, you know, on this time frame. And that's to be expected because we've got levels of liquidity within striking distance here. Always keeping in mind that still over here on the hour, we did have that break of structure. We still have not yet pulled up into any meaningful PD arrays here, and we're definitely not into 50% or so of the price leg. So for right now, bullish, overall bearish, and as day traders, we can win either way. That's the benefit, I guess, of it, one of them. You taking any trades, Jake?
No, I've just been watching this morning.
Okay, Jake's already out of the market. Jake had his daily requirement met, and Now it's all about resting, relaxing, drinking some coffee, and chilling. I'll trade you places. That's where I'd like to be right now. Just already had made my money.
Yeah, I started early, so
I
it's
saw the
it's
moves in London. That was just crazy. Right from the opening, that was just a classic, rip.
yeah, it just dropped right from the get go, and it's just it's just bearish order flow, and you have to follow that, and
Right.
you watch it enough times, you can see it.
So Addie pointed out that the dollar's dropping, which is something we use as an indicator for the market in general. When the dollar drops, the market raises. Um, they're diametrically opposed, and you can kind of use sort of like divergence between indexes, what the dollar does. If you see good reason to see the dollar dropping, PD arrays, higher time frame analysis, things like that, you can incorporate that into your futures methodology. ICT does that a lot. He uses the dollar, so it's definitely another way to build a framework for what you're trying to do. So the reason I came up with this advanced entry model is for what we're seeing right here. On the advanced entry model, I could have taken this trade right here. If I'd added my one tick, I could have got in here. Even though I'm in premium, I've identified that when we get breaks the structure to the upside with the same signals, displacement and what have you, this is displacement, and I don't know that I'd count this just because it's the NFP move, but this is definitely displacement. This is trend encouraging signal here. And as much as I am able to and do well on waiting for this reversal up here, why wait? I mean, if you have another high probability model that gives you similar results with equal or better returns and ability to place really tight stops, because on something like this, I'm not going to use the swing at the bottom. I'm going to try to find something a couple ticks below the bullish fair value gap, because I'm taking a trend move. I'm not going to give it as much room to turn against me, because I'm betting on strength. I'm betting on energy. I'm trading energy, and therefore if it comes against me, it's not going to take as much for me to prove that thesis wrong. So tighter stop on the trend moves, but lots of opportunity for big huge pushes to trail your stop up behind you. Once you get up here far enough, you can almost say, you know what, I need to see a market break a structure before I get out. That's not even a candle. You'd have to come down below swing point. But if after you build up enough profit, you decide what you're comfortable with. I could lose this many points and be okay with it, because if you allow that big pullback, you're then allowing yourself also access to the big rip. And the big rip can be 30 points on a day like this. It can go up here and take out weekly highs. So this liquidity is gone. This liquidity is gone. You don't need a body close for liquidity. If a wick blows through it, that's gone. So now we're up here on this level here, which that was a 15-minute, just a swing high back here. Beyond that, then not much there on the 15-minute, but it's a huge push, and this is just typical NFP day right here. There's nothing surprising about this move. Nothing about these candles is anything I didn't think would happen. When y'all got on, I talked about the sweep, the fake, the final picking a direction, and then we wait for all of that to happen, and now we're looking for a trade. And again, if you can sort of see it enough to practice it and think about it like that, it really builds your confidence that you're on the right side of all this. And confidence is, it's a big part of what we need to be effective. Confidence is what's going to get you in on the trade when you need to be, and not crush you when it loses. Because I'll tell you, it doesn't take but one bad trade to undo a week's worth of positive energy. You just get blown out on one trade, and I've had days where I was green 7, 8, 9 days in a row. Everything was beautiful. And then I take a bad day and I'm like, man, I don't know if I can do this. You know? And it's stupid. I mean, it's like my head playing against my own head, and I have to shake that off. And sometimes I won't trade the next day and get that out of my mind and come back and look for a base hit, you know, and then build on that. So now we've taken liquidity, but I don't trust it yet. It's too early for me. It's way too early for me to take a reversal since it's went this high. Now I'm expecting the big pullbacks, and as I said, I'm expecting this is too close not to get tapped on an NFP day. I shouldn't say that really. I mean, I don't want to get too predictive, but that's just my mindset. Is a lot of times this first big dip is the one we're looking for. This can fall. Let me show you how far this can fall and still be a bullish move. It could drop to here, dip through here, and then turn around and rip the other way. This is all part of, again, the process of getting people to go one way, turning the market against them, coming down far enough to reaccumulate shares from all the people getting stopped out, reaccumulating more shares. They're going to buy it down here. Everything that everybody sells down here because they get stopped out. All the people that went long, stopped out. There's a huge accumulation of shares right here. Farther down they go, the more shares they accumulate. Well, if you bought a bunch of shares down here, where would you want to get the market? Up here. Because then you're going to repeat the process. For them, when they're buying such amounts that this move is millions of dollars. I mean, you know, every one of these candles is thousands of contracts. So I'm on a minute time frame. This candle was 7,000, almost 7,000 contracts. 7,000 contracts. 5,000 contracts. 6,000, 5,000. A lot of money. And just as many people that bought down here, there's thousands of stop losses, thousands of, you know, contracts worth of orders sitting here that are getting blown through, accumulated, and then move back up here for them to then offload their position. And they're going to sell to the people who they induce to go long, and they're going to buy those shares. And it's just a repeating process of exchange between us and them. And our goal is to be on the right side of that exchange. So now we dip. So technically, I wouldn't have got into anything here. There's no fair value gap with a retest yet. But because of the day and because of what I'm expecting, I expect price to come all the way back down here somewhere, tap into the OTE maybe, and then go the other way. That's one possibility. Or we could sweep and come back down after some of this liquidity here. I'm probably not looking to really take anything until after lunch because of the NFP type scenario. It's not the same. I need to know we're getting close to the end of the day, and I know there's going to be a major liquidity targeting towards the end of the day. There's going to be a big move, and if I catch one trade like that, it's not worth me getting upset and getting frustrated and getting in and out of the market trying to catch these moves when I know I'm going to have a beautiful setup that's going to come. And the way I trade with the accounts that I have, that one trade will take me out. I don't need to make another trade the rest of the week. And if it's a really good one, maybe a couple. Just depends on the size and the confidence I have when I go into it. But and that's why we try to encourage the multi-account approach here. All right, Brian. Yeah, I'm going to do some kind of maybe on a Saturday when we're doing back testing and stuff like that. We'll go through and talk about TradingView, setup, settings, things like that. So Eddie's saying he's not going to want to short unless he sees a break through a 5-minute bullish fair value gap. So if we're looking at the 5-minute chart, here's our 5-minute fair value gap. Addie's saying he would need a close below this with an opposing fair value gap to then be retested to take his short. And that's sort of the 2022 model. that ICT teaches. So those are real good signals. Um, that's just another level of signal that you use. You use a body close below the consequent encroachment, which is the halfway point, which we didn't get. If you get the body close, okay, you're a little more bearish. You're a little more bearish, but now you're waiting for a body close below this one to maybe commit and a new fair value gap. You're always just kind of gauging your levels of confidence in where price is at right now, at this moment. What are we seeing right now? We're not using moving averages that tell us what happened, 20 candles ago from now. We're looking at right now, and that's, you need to be in the here and now to really make the good decisions. Okay, so again, I didn't want to go short. I understood, that we can come down here, tap below the 50%, or they're close. So we had a reaccumulation of shares. We had people stopped out that went long. Everybody's thinking this move. They want to see it. In your mind's eye, you're predicting price to do this. Okay, you've seen it enough. You're expecting price. You want price to do this. Okay? And the people that are buying long right here, they've convinced themselves that this is a possibility, and they're willing to gamble on this chance. Right? It is a possibility, and it could happen. But that's low probability, and the market knows that. The market sees all the orders being, orders set, stop losses, limit orders created, and at some point it says, we're going to go get that money, and it comes back down here and takes it, and then it will make the trek up here to where I said I thought was in striking distance on an NFP day for sure, and it'll take this level out, and then after that, got a little distance. Thanks, Lapsky. Glad you're enjoying it. Doing my best to try to be coherent and, just give you guys a lot of information, really. If you're in these enough, you're going to pick up stuff, and it's just going to become part of your mindset. Oh, I'm in a consolidation. I remember Mark drawing that little box and waiting for the little things to happen, and, I shouldn't get in because there might be a fake. If you just start absorbing that stuff, it'll become part of your personality as a trader. You either get it from me, or get it from YouTube, or get it from your buddy, but you got to be listening to it. You got to be seeking it out, and then you've got to be in the chart, actually watching it play out, and using your own predictive sense to sort of say, what, from what I've learned, this is sort of what I'm thinking might or could happen. You never say this is what's going to happen, but and I say it over and over and over, nothing will happen 100%, because if it did, we would exploit it and we would make all the money. So you can definitely trust that nothing is going to happen 100%. There is no holy grail. So Eddie's saying that on the 15-minute time frame, he saw something that was interesting. 15-minute fair value gap. It's been getting respected all week, so nothing has really got up here to touch that. We tapped it here. Wow, look at that. Is that a fair value gap that was tapped to the tick? You think that's random? Think that's random? That's not random, that's precision. There's a difference. Precision means that we can trust that the algorithm is operating as an algorithm. And it just sort of validates our approach. So this is the fair value gap he's saying. This would be a real bullish sign, if it closes that fair value gap, because it has been up there, close several times. It hasn't closed it. Even though we close a bullish, or we, have a bullish fair value gap close on this time frame, it doesn't negate what we're watching on the hour time frame, because on the hour time frame, we've got an even bigger fair value gap we'd have to close in order to consider ourselves ultimately bullish as far as market direction overall. And we don't have that right now. So getting a nice rejection out of that. Big push back down. So again, Here we get all the people that thought, okay, here's the turnaround. I'm going to get in long. All right. They're expecting the pullback. They bought the dip. That's a terminology that's, people expect it to come down, and they buy here when it's low because they're still expecting this move up here. What's the market do? Gets you right up to this place of liquidity that you thought had to be tapped. And this is how I've gotten burned a couple times, saying that this had to be tapped. And I got in strong, and I waited and waited and waited, and it did one of these. So that's happened to me a few times. It's in my lesson list now. I don't do that anymore. And that's how you grow. I mean, you have to make the mistakes, recognize them as mistakes, say I was wrong. The guy that told me that 6 months ago in his video was actually, trying to help me out. And I said, screw you, I know more than you do. I'm going to do this thing. And it doesn't work. So as you eliminate crap from your trading plan, it allows you to focus on what your actual, ideas should be, and what you're confident in and what works for you. So we had to fake this way. We had the big pushback to take them all out of their positions. Now what? What are we expecting here? We didn't close this fair value gap yet. We have not yet created a 5-minute fair value gap to the downside. We're still showing respect to this fair value gap here. So no reason for me to take a short just yet. We did break the market structure of this candle right here, and a lot of times I'd take that trade, but like I said, NFP is a little bit different. I'm looking for the ultimate move back, or the huge swing down here, and then the push back up. All this range stuff, I don't have any confidence in, because there can be so much movement on NFP day. A lot of people tell you just don't even trade it, and don't even trade the week. I mean, there's sometimes when the anticipation up to the NFP day can cause the market to stall, cause the volume to be low. You'll see days, an increase in percentage of days that the DR, IDR doesn't confirm during the days leading up to it, because there's just not enough. It's in a consolidation mode, basically. All it's doing is building this sideways action for the eventual sweep that comes on the release. So on a normal day, classical entry model, this would be worth taking right here, I think. There's plenty of reasons to, think short. We did take up some of the. It's actually not a bad spot to go short, because we're in this kind of this place where if the market's bearish overall, it made the big move up to take all the low-hanging fruit liquidity. To take any more on these higher time frames, it has to move a whole lot more than it's gonna. So wouldn't be a terrible time to take short. And we'll see, that might be the way it plays out.
Yeah, Mark, I kind of like that there. The only problem you have now is you have a 1 minute and a 2 minute fair gap below you. But, in hindsight, if you look at it, it's a 22 model. You have a little run up there where it took liquidity. You have your breakdown here where it took market structure, left a fair value gap. And that fair value gap you would have entered at is also a 2 minute fair value gap.
Okay.
So, you enter around 43, you're already 5
Yep.
handles down right there to the bottom of that. There's a 2 minute fair value gap that's in right now.
Yep. So classic model, this would have been a winning trade already had you took this. And it looks like this is going to be until it breaks this one though. We'll see. It sure looks like it will. Yep. So that's your normal. Here's your break of structure. And this is a nice level of structure to break right here. This isn't just a minor, swing. Why am I getting my wrong lines here? So break of structure right there. Big, powerful displacement. Leaves a fair value gap. Stop loss, if I was going to do a stop loss right here, Around at 43, I can't make it to the swing. I either would have went 5 micros to get up here, or I would have just took my probably a couple ticks above this fair value gap right here. So 43.25. And it'd still be about 4 or 5 points, but 5 points would put me in a good place. And now we've got real liquidity grab here. Yep. So all this is swept now. That'll be a heck of a breaker if it ever does come all the way back up here. We got the low, high, lower low. That's kind of the order block too, I guess. Or it'd be right in there with the order block. But that's a double area of interest. Yes, Blabsky. Oh, go ahead. What's that? Close below another level of shift right here. Yeah, and this was a good structure shift, strong structure shift, because what we were talking about earlier is we had this high and then we had this low put in and it broke this high. So it validated this low as the low we would need to see broken to actually indicate a real change of direction on this time frame. That doesn't mean anything on the higher time frames, but for what we're looking at right here, you know, and that market structure shift also came with closing a fair value gap, and then eventually we close the other fair value gap, and now we'll see. But that's what you want to find right there. And again, over and over and over, all day, every day. This is never going away. It can't go away because we're trading on the backs of the banks and the people that move the money. This is the way that makes them the most money. So if they try to change anything to like negate our way to make money, all they're doing is cutting off their nose to spite their face, because what they have right now is the way they make money. To change it, it's already as efficient as they've been able to make it in 100 years. You know, and there's so many different strategies out there, so many different ways to attack the market. There's probably times when they say, you know what, I think what they do is they find more ways to manipulate us rather than try to eliminate our ability to make money. So something might change a little bit, but as far as just basic principles like this, I think that's going to work for a long time. And this would have been a painless trade. You would have got in right here and you would have never been in the negative. You would have been profit, 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 profit. So we would have got out at 5 points for the partial. So fair value gap plus a tick, 5 points. Okay, so right here, we took our money and then we trailed with a runner. And honestly, you know, you're definitely looking at this area in here for terminus on the trade, but and with this consolidation, I probably would have got out. Because the last thing you want to do is, you know, make a nice trade like that and then have it come back up to your breakout on your, and once you take your profit, you're bringing your stop loss down to your break even anyway, so you can't lose any money, and you're guaranteed the money you took on the partial. Yes, Blabsky, if I couldn't get all the way to the top of the swing, I'd want to at least try to get a couple ticks above the next fair value gap above if you're going to take the lower fair value gap. If you take the higher fair value gap, usually you're within 5 points and you can get up here. But if you're going to take this one, yeah, up here, or even go 5 micros and put it up here, because when you take it here, there's still a good chance it's coming up here or up here before a final turnaround. It just depends.
Cool, thanks, mate. I'm not sure if you can hear me. I've had to join the stream on my phone.
Yes, no, I hear you fine.
Cool. First, thanks very much for putting the stream together, mate. It's really appreciated.
Oh, yeah.
One question I just had. So there, your stop goes above the higher fair value gap. If price was to retrace to the highest one, would you consider a re-entry there as well? So a second entry, or would you leave that one?
I'd consider it, but if I'm already in for my position here, like with what I'm doing right now is so mechanical that I'm using just one order, two contracts. But that's a good, yeah, that's definitely something you want to be able to consider because you're favoring these areas as being strong places for entries. This is a good entry. This is a great entry. This is a, super great entry because of the tight stop loss. So up here, I wouldn't have to risk as much. Um, I might take this entry here and just put it, just a little bit above. I don't know if I'd give it the full distance. Just have to see. And that's part of the repetition of it. You do it over and over and over, and it kind of sticks in you what worked and what's giving you success and where you struggled, and you kind of journal it and say, that one time when I went to the upper fair value gap, I only gave it 2 ticks and it went up into the order block. I would have been better off with the swing. So in your notes, you're constantly reviewing that and you're saying, okay, out of this many trades, out of this many times, this is what's highest probability for what this scenario was, because you're gonna repeat the same scenarios over and over, and you need a model for sort of each scenario. What do I do in this situation? You're gonna find so many times when you got these multiple fair value gaps. How many times did you take the second entry in at one? Was it a bad idea? I think it's a great idea. It's just like adding on, when it comes back later and taps into it the second time. Sometimes that's a good time to add if you're bullish overall or favoring the direction that it's already in. So you sort of just build your playbook of experience, and then you let that guide you, as you move forward. If you're not trying to build a playbook or something of statistics or, what you've learned, what you haven't learned, you're just taking trades every day. You're just, I don't think you're giving yourself the best opportunity for success. You really need to master this stuff. You need to treat it like a very serious endeavor. When people are trying to be doctors and lawyers, I put on the Discord that you can be making doctor lawyer money, relatively quickly in comparison, but you've got to treat it like you're trying to get a medical degree. You're trying to treat it like you're passing the bar. You're studying, you're cramming, you're losing sleep. You're not going to do fishing on Sunday. Whatever it is, this is your priority. This is your focus. You're attacking it with a level of, seriousness that I don't know what else to compare it to. This is the most serious I've taken anything in my life as far as a, financial opportunity, job, career position, schooling, things like that. And I expect it to pay off because I know what I'm putting into it. And I've had success in my life when I've really dedicated myself to things. And I don't see any reason to doubt that now.
Yeah, cool. Thanks, mate. Thanks for your explanation.
You bet. So we just closed. We're down here closing another one. So now, again, can't really take a short here, obviously. I don't like that I missed this trade, but I stuck to my plan. So what did I say? As long as I stuck to my plan, I got nothing to feel bad about. I missed an opportunity, but I'm still waiting on an opportunity. I didn't lose a dime. There's no reason to be upset about missing that trade. If anything, I got experience from it. I saw the market validate my model, right? It's always good, even if you don't get the trade, if you got the confidence to see it respected your levels exactly and did exactly what you wanted it to do, exactly what you tested, exactly what you expected. And trust me, any day other than today, because of NFP, I would have maybe still been in this trade because I see that, I pull the trigger, always. Sometimes, I don't even need to see everything 100%. I'm like, I know where this is going, and I get in. But definitely with this move back into this fair value gap right here and this big break right here, this is what you're going to try to get your bread and butter on, is these pullbacks. This is the 2022 is powerful because you're not going to see the immediate distribution. You're going to see the manipulations first, and then this big powerful distribution comes in, and it's doing exactly what we expect the market to do.
Yeah, Mark, this is just like you said. We had talked about the 45, 47 area before, and it did the classic 22. It ran it, pulled back, ran it again by a little bit, take liquidity,
Yep.
drop. You had 2 displacement bars that broke market
Yep, right here.
shift, and then you have an overlay of a 1 minute and a 2 minute fair value gap that it poked back into. What I was looking at, because I paper traded it, what I was looking at was the 45.36 level, which is the new day opening gap and the midnight open. So in my paper trade, I paired it right there. And then I just followed it down, just went through the new week opening gap, which is around 45.23. So, you're looking at a 20 handle drop and it's still dropping.
Right, yeah.
So it's just, yeah, I didn't take it. It's one hell of a trade, but
Right.
like you said, it's a repetition. It happens every day. You just have to wait for it.
Yeah, good point. That's the thing that you should have confidence in, is that this is going to happen over and over and over again. You don't want to force trades trying to catch them. If you don't have everything you want, don't take it. Don't give yourself a reason to get down on yourself and be like, well, I kind of knew that, I saw this or I saw that, or it was NFP day, or there was something that degraded my probabilities for success, and I took the trade anyway. Then you need to ask about that. Why did I do that? Well, I was impatient. I had fear of missing out. I've got this target I'm trying to hit on my eval, and I wanted to hurry up and get it over with. None of those are good reasons to go against, what your kind of your plan is your idea, once you get it established. So my established idea was not to trade until today, and I had to sit on my hands because I had told people I'm waiting until Friday. So if you see me out here trading, and I'm the guy that's going to be trying to explain, at least the level I'm at to explain this stuff, I can't be going against my rules. So I made the determination I'm going to sit on my hands. And I watched everybody make some really nice trades the last couple of days, and I was like, well, it's part of the deal. But I stuck to my rules. I added discipline to my toolbox. I practiced discipline. That helps me overall, so it was a good thing. It's not all about money. It's about your consistency, your ability to execute. There's a lot going on besides just the P&L. The P&L should be like the side effect or the benefit of you doing everything else right. If you follow your rules, you've got good psychology, you're managing your risk, money management, everything else. At the end of the month, you got a good P&L calendar and you made money. That's the benefit. But the goal has to be everything else. If the goal is just the money, you're not going to make the money, because you're going to be focused on all the wrong things. You're not going to be giving attention to the things that really matter. All you got is dollar signs in your eyes. You need a plan, you need rules, you need follow-up, you need journaling. There's so much you need to do to help you get better at this, and that's why we, at least at this place where we're at together, there's going to be a lot of focus on just these basic repetitive ideas. Yeah, Waleed, the previous day lows are always, always going to be an opportunity for NFP or FOMC days. Highs and lows are subject to get taken out, on the same day. Brian, the yellow lines are bearish fair value gaps created by down candles, and the green fair value gaps are just the opposite. They're fair value gaps created by green candles. So we understand these to be areas where price would bounce up into and then down. The green fair value gaps, because they're bullish, are where we would expect price to bounce and then go up. So I would not be surprised if it turned around. It came down here to all the way past it didn't close below it, but it's way down here at the bottom of the range for the fib. And it's in an order block on some time level. This is definitely an order block. Yeah, right here. If I drew this out on the 5 minute, it's in a 5 minute order block. It didn't close below the midpoint. So even though you had the big push down, you've got to be wondering, just like we had here, we had push down, push up. Well, could just be a deeper retracement. that's not going to take out this low, but stopped out everybody in the. It doesn't have to come down here all the way. To accomplish the market's purpose, it does not have to take this out. It took enough from here to here, and also caught a whole lot of people who went short right here, expecting this to be taken out. If you're, doing, levels of liquidity, and you've got this sitting here, and you formed a bias in your mind that this has to be taken out, and people do it all the time, and I've done it. I've said to myself, it won't get that close and not take that liquidity. Now you're putting words in the market's mouth. It wants to take liquidity, but it never said it was going to take all the liquidity. So be prepared for a stop short here. Don't get in when you're down. That's kind of the discount premium idea also. Keeps you from doing that. If you're looking at, your price leg, you can't take a short below this point right here if you're following your rule. And if you had this one fibbed, obviously it's even worse. You couldn't take any shorts, from here, but we're going to use the more extreme price leg to try to make our determination. A good push down, then possible rip back up here, but that's just being predictive. I don't know. I know there's liquidity up here. I know there's liquidity down here. What I like to say is I know where it's going. I just don't know the path it's going to take to get there. So there's no doubt in my mind, within today or the next day, this liquidity is going to fall. This liquidity is going to fall. Now, how I manage it to take advantage of that and recognize when it's in its final attempt to capture that liquidity, or that it has, and I'm going to catch the reversal. That's where the rules come in, and following your plan. So this is real strong. 5-minute fair value gaps up here. If you were a 5-minute fair value gap person, you would have just now been trying to take a trade. So that's why I appreciate the strength of the levels. The fair value gaps are usually a little more dependable than a minute, but at the same time, you're not going to get near as many trades. I'd rather take 5 and win 3. I'm never going to say less than half, but I'd rather take 5 trades and win 3 than take this one and win 1. Because at the end of the day, I'm risking the same, my target's the same. I would have come out ahead by just having a decent winning. Now I say that because my win rate is good enough to where that makes sense. If I was right around 50-50, well, then I'm going to want the one that's the highest probability. But if I'm 60 to 70, then the more trades I get, the better, if they all follow this criteria. Because this is what makes my win rate what it is. So if I deviate from that, then I can't really say what my odds are, because I have no clue. I know what my odds are on this trade. With a not a huge sample size. I haven't been doing long enough to say I've tracked years and years of it, but for the little bit of time that I've been applying it. So I'm just for the record, writing down how many people we got. Try to gauge our effectiveness by how many people show up for these. This is really going to be the focus in this Discord. We're really trying to make this live stuff sort of the pillar of what we do. Between that and you having the ability to ask questions at any time of any nature, I know how much that would have saved me in the beginning watching ICT, and then not being quite clear on something and not wanting to go spend 3 hours trying to research it or what have you. To be able to get a quick answer on something would have been huge. So Blabsky, when I'm looking at raids on liquidity, when I start out to mark up the chart in the morning, I look at my external liquidities from the previous session. So all these points are internal liquidity, intermediate swings. I'm looking for the uppermost and the lowermost. So these are only the way they are because it's NFP day. Normally you get a little tighter range, and I'll draw those lines at the top and the bottom. And then when New York Open comes, or if it's London Open, I have the session high and low previous to the London Open. And those are the areas of liquidity that I'm then waiting to get tapped. Because these internal ones are getting tapped over and over. You're going back and forth through them. It's harder to be as confident until you get up here. Like I know these are probably going to get tapped, but then when they do, it's makes it more certain. But when I've got them up here and down here in the full range in between, the next place for the market to reach towards is these upper levels and lower levels of liquidity, because there's just not much it can do back in here to make money. All the people that went long here are stopped out here. All the people that went short here are stopped out here. So what do you have left? Well, you've got the upper levels of people who went short and long who are still in their positions, and the market's going to attack those positions. Yep, you bet. So I'm going to take a 5-minute break or so while we're in this consolidation and stuff. Grab me a cup of coffee if you guys want to grab something or whatever. I don't see anything happening right now, and if it does, we just miss it and we wait for the next move. But I'm going to do a lot of these streams, and it's going to be sometimes an hour or two, so there'll be times I want to get up and stretch my legs or grab a drink. So I'll be right back. Kurt, if you want to take it over and just keep on going, I'll be back in just a few minutes. Or not Kurt, I'm sorry, Jake. Alrighty, I'm back. Oh, Jake took off just before I handed it off to him. My bad. I just now saw the text message. Can y'all hear me? Anybody?
Yep.
Okay, good deal. All right. So, yeah, I'm sorry about that. Kind of handed it off to Jake. Jake volunteered to sort of help me with some of these live streams and stuff, and he's going to do a great job at it. I also created a channel under education for Jake's trades. If you've been following his trades, he's got some really amazing recaps, information, really detailed stuff. I like having him, in the stream. We talk a lot, and he's got some really great insights. I've learned some stuff from him as well. So you'll definitely want to, be involved when he's in there as well, and you'll learn a lot. So, all right. So again, was this the big drop, or was it the just a retracement for an eventual continuation? We are closing now these bearish fair value gaps. We closed the major 5-minute fair value gap right here.
What I noticed too, we're breaking through those bearish fair value gaps, so I think we could deliver to the upside a little bit here and break through the other fair value gaps.
Yeah, I had to make a note. In the beginning, I was not thrilled about seeing a whole bunch of fair value gaps above me if I was wanting to go long. But at the same time, they're gonna get eaten up one way or the other. At some point, all these fair value gaps get ate up. So you can't let that stop you. You kind of have to go by what is the market doing right now. Did I get a break of structure to the upside right here? Well, I did. Did I get a fair value gap? I did. Did I get displacement? I did. Did I get a retest? I did. So for my advanced entries, the ones where I try to catch trends, this would be something I'd maybe target 3 points for. I try to shoot 3 to 5 points. But if I'd have took the trade right here at 31, well, there you go. There's 5 points. So even in an internal range trade in New York, because of the amount of volume you have and the speed at which it moves, you can trade against the trend. You can trade against the DR confirmation, because you're not trying to capture moves that are, ridiculous. I respect those levels. I respect the DR confirmation direction overall. I respect the overall trend direction overall, but I'm going to trade against it sometimes because I can. And I've proven that, to myself through my back testing and just observation, that there's plenty of opportunities if the model presents itself, right? So if we're looking at just my classic model right here, classic entry rules, we got our rated liquidity, came down here. We didn't take all the liquidity, but we took a lot of liquidity. If you look over, this move took a huge amount of liquidity and reversed. I might have gotten in here and not even waited, because as I call it, the advanced, I didn't get the break of structure here, but I got the level of displacement that I would have thought necessary. I got the fair value gap. I'm close enough at 26. At 26, I'm probably coming down here below this swing, or I'm using micros and I'm coming down here. Those are my two options, and every time I'm looking at how much distance I have from where I would take the trade. That's 750. That's too much. But if I went 5 micros, that's cut in half, and now it's a 3.75 risk. That's fine. That's great. I'm not going to make as much. I'm going to make a lot though. So it's, you constantly calculating and constantly, measuring what your approach is going to be, and you have those predefined. You already know in your mind, this is my plan. Here's what I see. Here's what I might do. I've got 1 or 2 options of the way to attack this, and keep it simple. I definitely would have got in right here and trusted that these swings would probably hold, and it would have been a good trade here. It still would have been a good trade here. This is the classic model. This is the advanced model. But for me, the advanced model wins enough and it's a bigger winner usually because I take it a little sooner and I do less risk. So this is kind of what we call a high resistance liquidity run, and I call it bleeding. It's just bleeding, 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 bleeding. You know, not giving you anything to get excited about, other than some, you know, it's respecting these bullish fair value gaps, which is good, but you don't have the same energy as like something over here, right? This is all same color candles, powerful moves. You know, on the 5 minute it looks really strong. On the 1 minute it's more of a just you know, up and retrace, up and retrace, up and retrace. No, Blabsky, I didn't trade yesterday. I'd set my mind that I was going to stay out of the market Tuesday, Wednesday, and Thursday for NFP, and I just stuck to that. I wish I would have. I'll tell you what, though, I'll make a note of this, and when I do the live stream on Saturday, we're going to do some back testing. We're going to do some going back through stuff and just calculating what our win-loss rate would have been, taking the model on every trade, and I think people get a lot of confidence out of that. We did it the other day, and it was really positive, you know, to see that, you know, out of 21 opportunities, we won 13 of them and lost 2, you know, and had 6 break evens, and we would have been up almost 70 points taking this same classic. Well, no, there was advanced. These were advanced. We took every advanced trade that we saw, basically. There would have been less classic entries, but those probably would have been even better percentage-wise because they're usually, they rely on more criteria being met. But like I said, for me, the win rate on it is high enough to where, you know, if I'm, just for the sake of argument, say 70% on the classic model and 60% on the advanced model, I'm still winning with the advanced model. So I'll still take that trade because it's going to put me in profit. And I get more of them too. So if you take that 60%, maybe I win less percentage-wise, but what if I am able to take twice as many trades? Okay, so from that aspect, it makes all the sense to take something that maybe has a little less percentage, but gives you more opportunity. So yeah, Saturdays or Sundays, we're definitely going to be doing something. Maybe both if I do one and Jake does one or something. We're going to give you as much opportunity to have live access to what we're doing, because I think that really brings it all together. And I think that's what we're going to do differently in this group or this Discord or whatever that's going to set us apart, is we're going to focus on the live stuff and the questions. I don't know how they do it in other rooms. I know a lot of it is, you know, if you're paying, you can watch the live stuff. And even then, I don't know how much interaction there is, but Paradise, it'll probably be early. Not this early as today, but maybe 8 or 9 o'clock New York time, somewhere around there. And we'll just kind of see how it goes. Like I said, Jake's volunteering to help on some, so that'll give us an opportunity to maybe either do 2 sessions on a Saturday, or 1 on a Saturday, 1 on a Sunday. And if you don't make anything else, these lives are going to be where you get your best information, your best opportunity. And as we take more trades, like I said, today I could have already been in, you know, I could have been in this trade here. I could have taken. This was a trade here, advanced. This was a classical. I could have taken 3 trades just based on these criteria, and all 3 of them were big winners. If you don't think this is amazing, I mean, I do. It gets me so excited to see something in the market that repeats and you can count on happening, and the hit rate is so high. I don't know of anything else. I haven't seen anything else. Maybe you guys know, something better. But for me, in the limited experience, this is unheard of, to be able to predict the market and make trades like this and have such a high win rate. And this is all you need. You really don't need anything else. If you learn this one thing, keep it simple. Don't confuse yourself. Don't add a bunch of different tactics and strategies and indicators. If you just follow this very basic plan, and you get to a point where you can either, you got enough money that you've got a, nice sized cash account, or you're using evals, turning them into PA accounts. Like ICT says, you quit your job in 90 days, if you already have some experience. But if you need to, get up to the point, this is what's possible. Let's put it like that. It may not be 90 days. My goal isn't 90 days yet. I'm giving myself plenty of time. But this is the model that can take you from 0 to 100 in the shortest amount of time, and I think has the most potential for, everything about it is good. The psychology of it's good. You're not dealing with something that only wins 30-40% of the time and hoping that you catch the home runs, because on those strategies you have to take every trade. If something wins 35% of the time and you get 3R, you're still making money, but you have streaks of wins and losses where, say you only take half the trades and you happen to get on the wrong side of the win-loss ratio, and the ones you did take then weren't the winners, weren't the home runs. You end up, in the red. It's a potential, and I don't really care for that mindset. I want something that wins high, that's low stress, not a lot of drawdown. I don't have the market coming back against me because I'm trading straight momentum. When I get into a trade, the market has already said, I've got a plan. I'm going to do something. I'm going somewhere. And all I'm doing is catching a ride with it. And if you can wait to get in with the banks, this movements are controlled by, people that have billions of dollars that can push the market one way, then push the market the other way, as well as the supplemental liquidity providers who are more geared towards the tick-by-tick movement of the market and the, controlling the bid-ask price and where the price actually goes. So you've kind of got two different people who are affecting the direction of the market, but they work together pretty much. So it's us against them, right? The more liquidity the algorithm generates for the banks and hedge funds, and those people that have the capital, it's generating liquidity from them, for them. They're getting a cut on that. They are paid to do that. That's their job. That's how they get all their money. If they don't generate that liquidity, then they don't make as much money. So it's in their interest to generate the liquidity by making it move like this. Then as the banks and the funds get in and they push price because of their ability to inject capital, then that's also another way that, the market's moving. And that's in sync. They're in sync. You might have fund against fund to some degree and bank against bank to some degree, but overall, they're all making money, lots of it, and it's unfortunately, at our expense. And there's like literally billions of us, and maybe, I don't know how many of them at all. I have no clue. Let's say dozens of big enough ones that can, affect a direction. We're the ones that are, we're the prey. They're the predators, pretty much. We're the liquidity, and that's sad, but that's the reality of it. And they're not doing anything to tell us anything different. A lot of the marketing, a lot of the media, even a lot of your influencers are in on it, and they're trying to train people to fail, or they're trying to train them to win 40% of the time. That's it. They're not trying to show them how to win every trade they take. They're not trying to show them probabilities that are, incredible, because then they become the ones taking the liquidity out of the market, and guess who that leaves less money for? Right. A fun fact is the people that kind of regulate the market, they only require these people to maintain a regulated price. And I'm not sure what it means by regulated. I'm assuming that it has to do with volume. If you have a lot of volume one way, there has to be price movement in that direction. They're only required to line up 10% of the time of the session. And that's kind of a ridiculously low number if you think about it. The other 90% of the time, they're willing, or they're able and allowed to basically manipulate the market. And, that's probably all factored into the algorithm. If you've got this much volume, you've got to do this much movement in this direction, et cetera, et cetera. And that's how we use things like tick grid, divergences, things like that to see when they are playing by the rules and then when they're not. So, Blabsky, let's see. 5-minute ES chart. We have not respected the bearish fair value gaps. No, we've blown right through all the bearish fair value gaps. No, I wouldn't consider an entry yet. Just it goes against my rules as far as discount premium. Now, and I say I've learned this from experience. I used to sit down here and think, well, it's so bullish. It's it's done exactly what you said. It looks like it's, you know, coming through these fair value gaps. It's going to head on up, and the next target would be this place up here. So I might wait for a little mini pullback right here, and I'd get in long. Well, guess what? Then it hits this order block right here, which is a powerful area of resistance. And on this particular bounce, this would be the first bounce into this order block. I have a higher expectation of it rejecting out of there and coming back far enough to have stopped me out, and then making the push back up and eventually taking this out. That's just from utilizing the PD arrays. Until it closes this one, I have no reason to believe it's not going to. And I'll use the halfway point first. I'll fib that as sort of an early indication, but I can't do anything this high up in the range to take a long. Now you can scalp that. There's, you know, like I said, I've done it and it's worked a lot of times, but when I don't, I put myself in a position where it's hope, right? I'm like, well, I'm hoping it's going to go up there. I'm going to give it a little bit more room because I really believe it's going to make this line up here. And then, you know, I end up, well, I'm just going to give it a little bit more. And now you're committed to giving it more because you've already doubled your stop loss, or you've added enough to it to where the loss is going to sting, and your psychology is thrown out the window. Now you will pull that down, and at some point, you know what? Here's what I've done. I said, you know what? F it. I either get it or I don't. And I come down here to a below or a swing point, thinking, you know, because I'm already halfway there, and I know it's going this way, and most likely it'll flip before it gets here. Well, guess what happens? It only has to come down here one time to erase all the gains I've made from all the trades that I followed my rules and I was positive on. I only have to lose one of these because I said F it, and it erases all of that. So for me anymore, that type of trading is just not in my playbook. You know, reinforcing bad behavior is exactly what it sounds like. You know, I've reinforced bad behavior by getting some wins. On the first eval I passed, I needed $800 in that day to pass it. There was no time limit. There was nothing. I just wanted to pass it on a Friday so I could feel good. And I scalped my way. I was going 5 contracts to get a point. I was doing all kinds of crazy stuff. And I made it. I passed that eval. I thought I was king of the freaking mountain. And it reinforced some bad behavior. And I always thought, well, I could always go back to doing that if I needed to, or it worked that time. And I've gotten burned on it enough times to where, you know, the one time that it worked for me, it wasn't worth all the angst and anxiety and irritation and frustration of the 1 or 2 times that it kicked my ass. So those are things we have to learn from. If we don't learn from those, you know, our progress isn't going to be linear. You know, it's not going to be just a steady up, down, up. It's going to be like, you know, back and forth, because you can get yourself into all kinds of twists over this stuff and find yourself not following rules that you know you're supposed to follow, and then ask yourself, why didn't I follow my rules? This is the weirdest thing, you know, as far as psychology. Let's see. Waldeed is asking, I know you don't trade NQ, but how about this one in my picture? Would you be looking for a trade here, as we have taken the low, earn a constant discount like ES, where we didn't take the low? Looking for a trade here up. You know, you're right, I don't trade NQ, but it doesn't matter. I guess the scenario is the same. It definitely, you know, the criteria were there. It was just kind of in the wrong place for me, in the middle of this range right here. And again, it still has a long way to go before I could consider, you know, it would be hindsight for me to say, yeah, I could have taken it and it would have worked. But for the knowledge I have right now, I felt like we had a break of structure on a higher time frame. When we go back and we look at this 4 hour, we might be a little higher on it now. Let's see what it looks like now. When I looked at it before, I hadn't seen enough. No. So 4 hour time frame, very bullish, very bullish, very bullish. We had a break of market structure, which is a stronger indicator than just a break of structure. This is actually a break in the market structure itself, which told me bearish. All we're doing now is we're just tapping into a 4 hour fair value gap. All this movement that you're seeing is a bounce off of a bullish fair value gap right here. It never even hit the order block, so that's more reason to assume that it wouldn't have plowed through, is because we rejected out of the fair value gap above the order block. The order block is going to be even a stronger point for a potential reversal. So for me to have taken a trade over there, being this close to this fair value gap and seeing it already reject out of here, out of here, out of here, I'm still thinking short overall for the course of the day. And what I'm waiting for the market to do is come way up into here, arc around over the course of the day and the afternoon, bounce around a little bit, and then eventually maybe swing back low. I don't expect it to come up here that high. So now, had I been looking at it down here, like this is where I missed the longs, where I was saying I was talking about the advanced model. I could have taken the longs down here and felt pretty good about it. But I'm really using the higher time frame analysis to make that determination. You can look at the different time frames and see different things that would have worked, or felt like you could have took a trade there, and it's sort of 50-50 on that. It depends on how much you're looking for. If you're going in with 5 contracts and you're looking for 2 points, and you see a bullish fair value gap right here and it gets respected, well, there's a couple points there. You could take that trade, but I don't want to live like that. It's more stressful for me. It's more potential to get whipsawed and get taken out. Now, if I'm already in the trade, I will add up here. If I feel like this is the target, if I would have taken a trade down here, and I'm doing so well, I'm in profit, I'm already at break even down here, I've already taken a partial off, I will play the fair value gap game where I see if it'll just respect it by a tick or two. So I would get in right here, very, very, very tight stop loss, and try to ride that up a little bit until one of these fair value gaps is not respected, and then I stop playing that game. But I see respected, 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 respected. So each one of these that come up, I would be looking to maybe get in, depending on how strong it looked and where we're at in the overall range. The higher we get, the less likely I would do that, but definitely in here. That answer your question? Yep, good deal. So now we're, the market it's always doing like 3 things. One of 3 things. It's either rallying, it's basing, or it's either rallying again or dropping. So if you just think rally base drop, base, rally, drop, this is kind of a base, this is consolidation. Even though it's in the up a little ways, you kind of get up here and you peak. Now your rally or base, rally, drop, rally, base, and now we're going to look for either a rally and a drop. It's the same as the accumulation, manipulation, distribution, similar, just different terminology. But whenever we get to these places where it goes sideways, what do? Somebody tell me what we do. We draw our box. And we've got our range, our consolidation range. And we're looking for price to make a break from one side. More often than not, that's going to be the fake. That's going to be the inducement. We're in a heavy uptrend, so it could be a continuation as well. But if it's going to continue, I would expect it to come down this way first. Take out this sell side liquidity, induce people to go short, turn around and go against them, come up here and take out all these people that were already short, and then carry the market in the direction it ultimately wants to go. This is the mindset that just repeats over and over and over. And as you're moving through the market in the course of the day, you're looking for these same things to happen. You're anticipating them. If for no other reason, it's an exercise in candle watching, building your confidence that the market's going to do what you think it's going to do. Because if it's going to do what I think it's going to do here, there's a good chance it's going to do what I think it's going to do up here, because I've already shown some sort of propensity to accurately predict, what the market's going to do. More times than not. Like I said, nothing's 100%. But when we get into these sideways ranges, from these comes good things. If you look at all the areas of consolidation, when you get your area of consolidation, when it breaks, there's a move. And that's because it's just generated enough liquidity So where it says, okay, now I can make a bunch of money, I can get my shares, I can take the market to the next level, I can offload my shares, I'm going to cause these people to have to sell their shares, I'm going to buy more shares, then I'm going to come down here, I'm going to drive the market down here, I'm going to distribute my shares, I'm going to sell them to all the people down here that are going to go long, and over and over again. That's the interaction, that's the sort of the exchange, the way the exchange happens between the market and us. The big players and us also. They're on the opposite side of everything we do pretty much. So the whole goal of this style of trading is to be on their side, trade with them, recognize when they have accumulated their shares, and then we ask ourselves, okay, what's the next best thing for the market to do? If I was a bank and I just accumulated all this liquidity, well, where would I want to push the market? And then you use that as a sort of a directional bias to say it makes the most sense for the market to do this. Doesn't mean it will, but building that is sort of like a muscle memory for you, like a reflex to react to what you see or not react to what you see, which is just as important. So here's a very small liquidity sweep right here. Algorithmically that counted. Took out this low here. If it keeps going sideways, I would just move the box down a little bit. Just really, yeah. There can be some fluctuation within this range before it really makes a several tick move or points through the box. Hey Crystal, hey Psych Cypher, Summer Fox, good to see y'all in here. There's a few names I don't recognize. There's a lot of names I don't know, and some of you make it really hard on a fella to try to just talk to people in the chat, but I think I'm one of the few people that has the same name on Twitter. Psych Cypher does, that's the same Twitter name. And Jason is close. A lot of you are, have different handles for the different social media. And with, I don't know how many people we're up to now. I think we're pushing 250. So there's a whole lot of people I just don't know. I know other people are kind of promoting this too on their YouTube and what have you. So some of you know me, some of you maybe don't. But again, we're going to try to make the live streams the bulk of what separates us from everybody else, and the freedom that you guys have to ask questions and put your charts up and things and get comments on them. We're by no means experts at this. In fact, there's people in this room, in this chat right now that have more experience than I do, and I wouldn't hesitate to say are better traders. So let me get that out of the way. That's why I rely on so many people. You're going to see a lot of admins. You're going to see a lot of people in the willing to help section, because I recognize there's a lot that can be contributed beyond just me. Right, you bet, man. Thanks. Good to have you. We'll see you when you come back. He's a DR guy, so I know a lot of you are DR traders too. And unfortunately, we're not going to have a lot dedicated to that. Maybe down the road we set aside a separate time to really get deep into DR with people. But I don't want to confuse the people who are new between the two strategies, because they are so different. You can work them together, but the fundamentals are different, the execution is different, everything about it is different. So my goal is the guy that's been trading 2 weeks and the guy that's been trading 2 years who hasn't been able to have any success. So that's what this Discord's for. Everything else is just people collaborating and having a place to call home that doesn't cost them $100 a month. Because trading is boring, I think, and if we have a place where we can interact and bounce ideas off each other, it's definitely a positive atmosphere. Okay, so what is this? Is this going to be the true move, or is this going to be the fake move? Or are we just raising the level of the box? It went up high enough to where it's one or the other, I think. Once you get a range of consolidation and you get that break, that's enough for the breakout traders to go long. Some of them will wait for the retracement and then the bounce. A lot of them don't. They've got a limit order. Once there's been so many candles of consolidation, they place a limit order right here. And when the limit order is tagged, they're into the trade. They'll have their stop loss at some point down here that they think is sufficient to either give them enough room to take a little bit of a retracement or get them out when their idea is proved wrong. But anytime I've tested this type of stuff, it just didn't, I wasn't impressed. You know, I mean, like I said, there's people that might win on this some. They might feel like it's the way to go, and but you can watch it playing out so many times that it just does the same thing, and I'm like, yeah, if I would have went long right there, I'd have been screwed. So we'll see what happens here. Like I said, there's plenty of times when you get the rally base rally, and that could be what this is, especially on these high resistance liquidity runs. This is expected because of the big push we had down and then a slow bleed back up. But now we're ending another fair value gap up here on the 1 minute. And we've also tapped into it on the daily. So that's a huge factor right there. This has been tapped into on the daily already. Daily fair value gap. Being the higher time frame, we would give the more strength of consideration to. So I'm still short biased. 4 hour time frame, we're short. Just doing a little pullback into a fair value gap. Maybe capture some of this liquidity in the fair value gap. I could see that happening for sure. But I don't expect that fair value gap to get closed. But we'll make another determination. You know, as it gets closer, we'll fib it. We'll find out what the consequent encroachment is. We don't have to be right about the whole thing. Everything's in stages and increments. That way we're not making huge judgments on huge movements. You break everything down into smaller chunks, and you can say, you know what, I'll wait until it gets halfway through and see if I get a body close above the consequent encroachment. If I get several rejections off that consequent encroachment, I get a signal to the downside. Pretty strong indication that we've changed direction, or that we're going to. So daily and 4 hour, different levels of encroachment into their fair value gaps. And then a little bit of a rejection right here. Now again, if you don't have these on your chart, if you're a retail trader and you're just looking at support and resistance, or, you know, I could put an anchored VWAP on here somewhere. Let's put it, normally when I do anchored VWAP, it would be beginning of the session, so 8:30. And it's probably going to be thrown off because of NFP, but, right, so you get above VWAP, you take in longs. That can be an added confluence. But without these levels, you don't know at what point to expect a turnaround. Now, if you don't have that on your chart, you have no clue why this is doing this right here. We, being smart money traders, we're looking for algorithmic interaction with price. We're looking for levels to be priced to, liquidity to be taken, imbalances to be balanced, inefficiencies to be made efficient. That's how this thing is programmed to deliver price. Nee, I'm going to maybe mute you here in a second. You got some noise going on. So anyway, I don't use that really, other than just for kind of making an explanation of how that can work, having lines, different things on your chart. So we had a little base, little rally. Now we're basing again. Bullish, you know, fair value gaps being created. Looks solid for a push up. And yet we're still just tapping into those other fair value gaps. So this is just a no man's land right here to try to take trades. There's too much going on. There's too much that we can see that many people can't see because they're not using this stuff, right? Having this on your charts, or the ability to look at it, is really huge in my mindset, because if you're only looking at this, it's a very narrow view, very narrow window. You need to know since we trust these levels, and since we know they're effective with price, we need to always be monitoring them at different levels, because something may not appear on the 5-minute chart that's a huge impact, a huge weight of, you know, potential activity with price sitting there, that's going to cause it to go in a different direction. And we need to see how it reacts with that level before we can make any determination to take a trade. So on all these fair value gaps, we split the middle. We see where we get our body closes. Does it wick through? Does it body close? And then putting that information together kind of tells us how to anticipate the rest of the move short term. Nothing's long term, but you're looking at candle by candle, a few candles at a time on your lower time frames. So I would almost say we're still in consolidation. And yeah, that's my low, that's my high. What time is it? It's so it's just now lunchtime in New York, 12 o'clock. So we'll see, you know, lunchtime has its own sort of way of trading. The market recognizing there's less activity, less volume, is going to cause the algorithm to price differently. And we see that ICT teaches on that pretty extensively about how to trade lunch and what to look out for. In earlier videos, he said not to, but then, you know, the levels it creates and the macros that run around that time do provide opportunities to take trades. So, and a lot of my back testing, I found trades within that time. So that's why when people ask me, you know, do I trade the straight silver bullet? I tell them no. I mean, a lot of the criteria are the same, but I'll relax my requirements for the time frames. And depending on if I'm in a live stream where I'm trying to show you guys something, or if I'm just on my own, you know, on my own, I'll take them anytime. On the live streams, or in general, the classic model is to take those hours between 10 and 11, and then 2 and 3 and 4, 2 and 3, something like that. I like 2 to 4, a 2-hour window in the afternoon. But like I said, I'll trade at any time. New York, you can really trade any time, because at any time you can get a huge push, lots of volume. London, if you're trying to trade it past the first hour, a lot of times you're going to get stuck in choppy, you know, low volume stuff until later on when it goes to sweep Asia's highs or lows. Then you'll get some movement towards the end of the session. It's a lot easier for me to sit through a whole New York session, because I know at any time I can get a trade. New York's a little more difficult to do that with, or London. Now, all these live streams are going to get posted here. Education live streams. So you'll see I've only done one so far. If you can't watch it, you can go back. I'm going to try to make some time stamps, and I forgot to do it today. I was going to make little notes that I could put time stamps in to give you guys a way to jump right to what matters, so you don't have to try to go through the whole thing. So once I start doing that, that'll make it easy just to kind of pop the video open and say, oh, okay, here was the trade. Here was a good lesson on, you know, AMD, or rally-based rally, or just whatever it is I think that's important that, you know, I'm believing would be good information from you. I'm going to try to get that into the stream. So, and when you see these, do me a favor. If you got something out of it, share it. Share it and say, you know what, I was in this stream and it was dynamite. It was fire. I learned some stuff, whatever. That's kind of my way to expand the reach. And obviously I'm not doing it for money, so it's to help people and, you know, try to make an impact on the trading community that's not based on how much, you know, we can make off people. So like I tell people, I'm going to make plenty trading. I have no doubt. That's going to be, I'm going to quit my job eventually. And, you know, I'm being positive. Nothing's guaranteed, but that's my goal. And if that's my goal, then I would be sort of shortcutting myself, or I'd be going against my principle to say, here's how I'm going to make money, but then I need to charge for, you know, whatever. Being a year into this, I don't have any business trying to make any money off anybody. So anyway, yeah, if you see the tweet, do me a favor, retweet the tweet. If you see it on YouTube, retweet the, you know, reshare the video, and we'll see what we can grow this into. And as we do grow it, I'm definitely going to be relying on more of you guys to step up and sort of help out. And y'all are. I mean, I see you guys answering questions and helping people out, and I think that's fantastic. That's really the kind of community I want to see, grow, because a lot of it's toxic. Just, I don't know, not places I'd want to be. So let's make this a good spot for people, especially new people. All right, so we got another little pop here. Still bleeding, just bleeding. Very high resistance liquidity run. The liquidity is up here. It just takes a very, very measured path to get there. But it's also, it's making money on the way to make money. That's, there's nothing wasted here. This is the most efficient, the most efficient hunter in the world, as far as I'm concerned, is the stock market. Every one of these candles is determined to get somebody into the market, out of the market, or induce them to get in or out. So it's back and forth. And we might say, well, if all the liquidity is up here, why is it taking so long to get there? Well, that's because it's generating so much more right here. All these people that see this move right here, they go short, right? They're like, wow, I got 4 candles in a row. And there's all kinds of ways and different candle patterns that they'll be reading on even lower time frames than I'm on right now that tells them to go short right here. So they'll be short. It made it over halfway or something. Whatever the rules are at every one of these places, there's thousands of us making judgments and decisions on what we think the market's going to do and how we can make money. The greedier you are, the less concrete your rules are going to be, the more subjective you're going to be, the more you're going to base it on hope and what you want to happen, rather than reading what the market's doing, taking the signals it's giving you, understanding where you can get in on the side of the market, which makes all the difference in the world, I think. And that's why they call it smart money. It's a smart money technique. There's smart money and dumb money, basically. And if you've watched, I don't remember which video series it is. In the 2016, he gives a real good explanation of smart money. And I don't know if he uses the term dumb money. I think he uses uninformed, which is a better way to put it. So it's sort of, which side do you want to be on? You can make money as an uninformed trader, but I don't know that it's what your longevity is going to do, what it's going to do to your mentality. There's probably people that make a lot of money on this doing different things, but they're nutcases. Because it's up and down to make, a 3% gain over the course of whatever. And yeah, they can say at the end of the day, I'm a profitable trader. But at what price? At what price? What did it cost you in mental capital to perform like that? To always be gambling, always be judging, guessing, taking high probability chances. I don't want to do it like that. I want it to be, low stress, highly profitable. I want to feel like I'm in control. I don't want to feel like it's the market dragging me around and always got my number. And, that's just a frustrating way to trade. Even on the days where I won, I knew, and the market knew, that it wasn't anything I did. The market was going after bigger fish, and I got lucky and, caught some moves. But it's not like I was able to sit back and say, oh, I got this trading plan, and I followed it, and I got the results I anticipated. I didn't have any of that. Now I have that. And that's, I don't know of a better way to do this, but like I said, I've only got a year into it, so I hear people, especially on Reddit, I get blown up on Reddit because I post, and they're just like, who is this guy? What do you know? You've been doing this a year. And I'm like, yeah, I know, but still, here's what I think about it. And I got, not in an argument, but I got kind of flamed about saying that this doesn't have to take 3 to 10 years. There are people saying this is a 3 to 10 year thing, and your second and third year are going to be the hardest. It's going to suck the most. And I'm like, dude, I've been doing this a year. The next 2 years are not going to suck the most. And I got pissed about it. I was just like, why would you tell people that? That discourages people beyond measure, especially those that haven't had even a little bit of success yet. If you find out that everything you think you've learned and everything you've applied, maybe you haven't really seen any results yet, and you think 2 more years of that or worse, I don't think so. I don't want to do that. So I got on Reddit and spoke my mind about it. And I qualified it at the beginning by saying, hey, I'm not profitable yet. I feel like I'm close. I feel it, I've made all the mistakes that, people told me I was going to make. I'm still in the game. I've made adjustments to make sure I don't continually make those mistakes. I don't see as many ways for me to fail as I did in the beginning. Doesn't mean anything, but it was just my sort of perception of where I'm at today. And the overwhelming majority of them were just like, dude, you don't have a clue. Come back in a year. The market's going to eat your ass up. That stuff won't work forever. And I'm like, well, the stuff that I'm using has been working forever. I mean, this is the way the market's been moving. ICT's been teaching this since, I don't know. I mean, he's got a 2016, and I know there's stuff before that. So let's just say going on 10 years, it's been working. His students have been making money. Nobody's been able to say the fair value gap stopped working, the order block stopped working, the liquidity raids have stopped working, the AMD has stopped working, the rally-based rally, the consolidation model. What has stopped working? Okay, if it stops working to that level, it stops working for everybody. It would have to crash and just run out of liquidity, and the market just dives, and we get a black swan event or whatever it's called. If that happens and my stuff doesn't work, guess what? Nobody else's works either, and I don't feel any worse off. So lunchtime, not doing anything we don't expect. A lot of times you'll get, some consolidation, maybe not this tight, but lunch will just kind of range, and then after lunch, we look for those lunch highs. We treat those as areas of liquidity, even internal areas of liquidity that's going to be a high probability to get taken out before reaching for the upper levels of liquidity. So we've got bullish signals here. Might be forming a bearish signal here. So just a lot of confusion in the consolidation areas. We haven't really broke out yet, so I'm going to expand my box. It's broke out, but it hasn't reversed enough. So if this becomes the reversal, then this would have been sort of the breakout in here somewhere. But it's just nothing that really pushed. So that's why I just keep moving the box up a little bit. To me, this is still consolidation. If you were in the trade and still making money, this is, it's good. But trying to wait for the next energetic move, which is what I base my trades on, there's nothing in here to really work with. Technically, this would have been an advanced entry. Broke market structure. That's displacement for what we have by comparison, right? You've got green, yellow, yellow, green, yellow, yellow, green, green, yellow, yellow, green, yellow, and then you've got green, 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 green. Bigger candles, fair value gaps, short-term bullish bias here. This would have been a scalp for, if there was a high right here, and I was going to try to make that move that I said I don't like to make, this would have been the best time to make it. This is a couple points here, which from 44 to, so 3 points, and 3 to 5 points is my range. So if I see something like this and I want 3 points, I'm usually pretty confident I can get it, and this is what I would see to take that. But it's not in my classic entry rules for today, so we're not taking it. I'm going to trade a little differently in here than I do when I'm just on my own, because I'm not worried about going against a rule or giving you conflicting information. There's really nothing set in stone for the most part. Everything is situational. Judgments are made based on sometimes just a couple 3 candles and a level, and some bullish activity here that tells me I probably got 3 points here. I'm going to risk a point, right? I'm going to see if this fair value gap's respected by a point. So it's a 3 to 1 trade. If I win, high probability, I see what I need to see, but I'm not going to give it 5 points and put it down here at the swing and hope that works. That's just a different application of the same overall strategy, the same criteria, just sort of a micro version of it. Did we lose Addy? Yeah, we lost Addy. So 1050 is, I believe, one of the times we expect a macro, so we didn't really get one there. And I could have actually, 1050 was right here, so this could have been the macro, you know, a change in delivery right at 1051. So it's not to the extent, you know, that we look for when we're trying to make big moves, but it's interesting that it coincides with that time frame that ICT gives for something to look for. So the combination of that, you know, with this, looking at 1050, seeing the bullish push, I might have anticipated a bigger move, but I'd have been prepared to get my 3 points and get out. And with 20 accounts, here's why my thinking has changed. With 20 accounts, 3 points is $3,000. So, you know, I mean, why not take 3 point trade and quit for the day, right? I mean, if you can find it. It's definitely changed the way I target and the way I, you know, try to figure out what a good day is as far as points and risk to reward. And again, just takes the stress off. I don't need 10 points. I don't need 5 points. I would encourage everybody to definitely, you know, investigate that, see if that's a style you can do. I think that's going to be something else that we focus on that's going to be game changing, is getting people through evals and into PA accounts, developing some really solid eval strategy and rules, tracking stuff to help you set realistic targets instead of just trying to pass the eval. We want to get you to where you're passing it at a pace that would sustain you if you just kept that pace, that would make you happy. A lot of times people try to pass them in a week just because they want to say, hey, I passed an eval, and, you know, post Twitter and certificates and all that. So you pass it real quick, and then it's time to actually trade the PA account, and you realize that a lot of what you did to pass the PA account wasn't repeatable, wasn't high probability. You might start thinking you got a little lucky. And I'm saying this from experience because that's what happened when I passed my first one. So it changed my attitude and gave me a lot better way to attack those, I think. And we're going to try to share that and get some templates or something for you guys to use where you can just fill out the stuff and track your own progress through it. But having those multiple accounts and not having a lot of your own capital invested, you know, what's not good about that, right? Right now, Apex is running a 90% off, 80% on the monthlies. So you can get a 50K account for about 20 bucks, right? And let's just say it takes you a month to pass it. So you paid $20 for that account. You pass it, you got to pay the $150, $160 to maintain it, you know, for the lifetime fee. So for $180, you got access to $50,000 worth of capital. Think about that. And you get to lose 2,500 of it before you lose the account. So if you lose the account, you can reflect on that and say, gee, I would have lost $2,500 of my own money. I'm probably not ready for a cash account. But if you make money, then there was little risk to you. You're able to trade with a less stressful attitude because you know you're not losing the rent money. You know, you got 180 bucks in this after you pass. You're only 20 bucks in for the eval itself. The only thing you're wasting is time, which I want you to recognize your time is valuable. I blew through like 40 of these counts. I was doing them in groups of 10, and I was YOLOing it and gambling it and thinking, man, if I could just hit, you know, 5 points, 6 points, 10 points or whatever. And I kept not having a plan, basically. And I'm a month or so in, and I'm like, you know what, I just wasted a month. And I did the math on that, and I was like, okay, no, that's not the way to approach this. This gambling doesn't work, not for me. And it was costly because I might only had, say for the 10 accounts, say it was 200 bucks. Well, my month of time that I spent dicking around blowing accounts cost me a lot more than that. So after that, I changed my approach, and you know, that's how I passed these first 10. So setting a pace that's good enough to where if you didn't change anything, you'd make enough to quit your job. If you set your eval pace to the kind of pace you would need to quit your job, then when you pass your eval, you don't need to change anything. You know, they say that when you pass the evals, then you've got the different level of stress and pressure and things change. Yes, that's true. I got into my PA accounts, and the first day was great, and the next two sucked, and now I'm trying to dig myself out of a hole. So I wasn't prepared for that. It's the first time I did it. Learning lesson. You know, now I have something to apply next time I get in that situation. If I do happen to blow this one, I'll know how to do better. So that's what we need to do. Is just, it's progress, not perfection. Incremental improvements across your strategy, across your mentality, across your ability to understand all the the market. If you get a little bit better at each one of those over time, you can be confident that you're going to get this down. You're going to do really, really good as long as you see progress. If you keep doing the same thing, keep ending up breaking the same rules, keep ending up violating your trading plan, then you're going to struggle, and you need to find a way to conquer that. You've got to master yourself before you can master the market. Otherwise, there's no light at the end of the tunnel if that's what the cycle you're going through. And you'll run into people, and they might be the ones on Reddit that are giving me a hard time because they've been doing this for 10 years and they keep doing the same dumb shit. So, I don't know. And I'm kind of just blabbering because really there's nothing going on here, and I see there's still a bunch of you in here, so I'm trying to be somewhat informative or give you what I can. If you got questions still about anything in trading, right now is a good time to ask while nothing's going on. Where's Brian at? Did Brian leave? Brian's full of questions. Brian be hitting us up pretty regular. Let me get this chat window back up. You've probably been talking to me and I didn't even see it. Okay. Yeah, I don't have an affiliate for anything yet. Oh, I missed a bunch of stuff. Hey, Cloud Surfer, sorry I missed all your stuff. Waleed, let me back up a little bit and try to cover some questions here while we're in consolidation. Do I execute only on the 1 minute? 90% of the time, yes. I'll look for 5-minute models like this to also perform, but I've got the 1 minute open at all times, and I'm sort of using the 5 minute to verify what I did on the 1 minute. I'll use limit orders. So you can set a limit order at anywhere you want, and it just creates a line, and then when price hits it, it activates the limit, or the buy stop, sell stop orders. It's an automatic order that when price hits it, it triggers. So yes, I do use those to get into the trade. I use them for my partials, and I use them for my target. I will slide them a little bit as the market moves to make adjustments for certain circumstances. But yes, I do like to use the limit orders. Bottom, middle, or top of fair value gap. My limit order on most of them, depending on how much distance I'm giving to my stop, is going to be at the top of the fair value gap, or the outermost edge, depending on which way it's going. If it's a huge one and I got a lot of space, I might use the consequent encroachment and fib it in the middle and use that as my area. Very rarely, maybe on like an NFP move, if I'm trying to pick this move right here, and I want to say that I believe, based on liquidity and based on everything else, that this is the fair value gap it's going to react on. And we were talking, this would have actually been probably the one I used. I never would have used the first one. The second one gets enough of the fair value gap or the range to gobble up tons of liquidity, but it didn't go down here and break structure. And since we're, right now in this leg anyway, we're bullish, I wouldn't have expected it to break this structure. So I might have used an order here somewhere and then a couple ticks below it for a stop. Just depends on how big this is. This is on the 5 minutes, so it's only 3 points. Yeah, that's just stuff you have to kind of play with and journal and say, I did this 10 times, and 3 times I did this, 7 times I did that. And that gives you information that you can use for probabilities, statistically, what is going to give you an edge. And if you have enough of those, and it's a lot of work, I'm not going to lie. What I'm talking about doing outside the charts is as much, if not more, of the work you're going to do just trading. This part here is really not a lot to it. Once you get everything else down, it gives you the ability to sit here and execute on price. Yes, exactly. 3 points times 20 is 60 points total. So that's $3,000. and that's changed the way I approach trading. How long did it take me to pass? 28 days. I had a target set for 38 days. I wanted to pass by August 1st. So I took 30,000 divided by 38, and that gave me my daily target. I needed $790 a day, and I ended up, my daily actual was over 1,000. So I was ahead of the pace a little bit. I knew what I needed to hit at that pace. If I would have passed it, in exactly 38 days with 10 accounts, that would have been the equivalent of $115,000 a year, and that's enough for me to quit my job. So, and adding 10 more accounts, now that pace was almost $250,000 a year. There's no reason to rush this. There's no reason at all. Especially, when you're dealing with the multiple accounts, you're trying to get base hits. You're trying to stack the multiplication factor that you have because of that in your favor. And it can allow you to really just relax. I can take a trade a week with 20 accounts. One 5-point trade, this move was $5,000. You can take the week off, I'm not saying everybody's going to do 20 accounts, but if you do 10 accounts, that move is $2,500. If you do 5 accounts, that move, is $500. So, yes, Blabsky, I recommend the 50Ks for 2 reasons. The target to drawdown ratio is second best compared to the 25K, but you get a little bit more drawdown to sort of, you're still going to be trading a contract or the same amount of micros. So for me, I wanted the $2,500 drawdown and a very close, ratio as far as target to drawdown. Here's the thing. If you buy a 50K, the target's $3,000, the drawdown is 25K or 2,500. Now, to be fair, if you bought a 100K account, okay, let's say they double the target. Target goes to 6,000. What should the drawdown be? Drawdown should be 5,000. But they give you an extra $500, right? So they double the distance you've got to go to pass, but they only give you 20% more of the ammunition you need to do that. So the higher you go, actually the less your chances of being successful are, and there's no gain at all. I will never trade 10 contracts at a time, right? I can trade 10 contracts with a 50K. Well, great. With 100K, I could trade 20 contracts. I'm not going to trade 20 contracts. I mean, that's just, nobody needs to trade 20 contracts with multiple accounts and all that. So it's almost more of a marketing ploy, and maybe they cater to the people. There's a lot of people that want to say I'm, 6-figure funded or whatever, and they're going to go after that 100K, or it's just a way for them to put different prices on things. It's like anything else, If you go get LASIK right now, they got 3 different packages. You can get or cataract surgery. You can get your eyes fixed at the dollar store level. You can get the Walmart package, or you can get the Saks Fifth Avenue package. And it's just a way for them to put different price points on stuff. They're not trying to give you the best value. They're trying to, give you the most, gather in the most amount of people that can do this as they can. So, I'm officially an influencer? No, hold on. I gotta show you this. So yeah, I already banned this guy. So is this the criteria for being an influencer when people start when they fake your account and start trying to pimp the members? Many equities inside day fluctuations. I think one can achieve more successful trading with proper tactics and update. So my buddy got this exact same marketing ploy in a different discount, and the guy presented him this deal that just sounded really good. And it's funny, it's almost the exact same one. So, and that's why I put that information in. That's why I tell everybody read first, because you need to be aware that that's going to happen, and they're going to try to take advantage of you, and they're going to try to sell you something or get you to copy trades, and you're going to put your money in an account, or they're going to give them access to your account, and dependent on how technically, what your technical aptitude is, you may not be able to discern that that's bullshit. Can I get my video taken down for saying bullshit? I don't think so. I don't know what the the thing is for YouTube, but I'm definitely not gonna drop any F-bombs. So start with that. So yeah, still just kind of time dilation. Crystal said she did almost 400 per account today. Well, that's something that you have to learn from experience. Get in there, and if you're making your A+ trades and you're trading your model and you're having a good day, don't stop. Set aside a portion of that and say, okay, I'm going to use this other 100, and I'm going to take the rest of the day and see what I can do. But no matter what, I'm not going to go below 300 profit, 200 profit. And you've got to stick by that rule. Even if you lose it and you're tempted to try to get that back, if you start breaking rule after rule, it's a death spiral. So set a rule like that, give yourself some flexibility, and then stick to it, and you get the best of both worlds there. You're going to retain your capital that you won. You're going to have a nice profit. You're also giving yourself a chance to make more. There's nothing wrong with that. That's what we're here for. 2 trades. Holy cow. What time did you take them? Yeah, right. That's going to happen sometimes. You get everything right but the stop. And there's nothing wrong, or there's nothing worse than when it's by a tick or two, because if you would have just pushed it up a little bit more, you would have had a huge banger. So 725 on ES, she took a trade. 725, you took a pre-NFP trade. So fellas, she took this trade 725 New York time would have been okay. Never mind. 725. So she took a short. It was a short, right, Crystal? At 725. Yeah, it has to have been. You didn't go long right here. Oh, 1025. Okay, well, there was a short right here that matched the criteria that worked great. Uh, Displacement, market structure shift, fair value gap, retest, bam. But she says she took it at 1025, so let's go look at what happened at 1025. 1025, that's in this area where I said would have been, a good classical entry right here. A good solid break of structure. And it looks like she took maybe this fair value gap in here somewhere. And she made, yeah, 400 bucks. She rode this up here and made good money. So good job, Crystal. Right, nice. 1022 to 1027. Okay, 1022. Perfect. 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 That's your model right there. That's what we're looking to do every day, over and over. So she took this fair value gap at 1022. Okay, so your market breaking structure is right here. Breaking structure, displacement, fair value gap, retest. All right, excellent. Right on. If you wait for that, I don't know that you have a better model in trading. I really don't. I just, if anybody's seen anything that is easier or hits better or has less drawdown, let me know. Because this is money. And especially once you get this break structure, the odds of you getting stopped out with all of that information working together in your favor is just really, really low. I mean, the market tends to do a certain thing when all these things line up. So again, like I said, lunchtime, consolidation, you'll get a, before long, both sides of this will get taken out, either as a fake or as a retracement when it comes back down. But this type of liquidity doesn't get left to stand. All these people that went long, all here, there's no way the market would just rip for the rest of the day, because all these people would then take their profit up here, and instead of selling, or instead of getting stopped out and providing liquidity for the market makers, they would be taking the profit themselves. So when you see something like this, you can anticipate before there's too much of a move for some of this to get taken out. And maybe that's maybe that's where we catch our our displacement to the down leg and a fair value gap or something. But it's just part of another way it's not random, because if it was random, there'd be all kinds of times where you'd see this consolidation and then it would just take off and go straight up. Why? There's no reason for it to keep dipping down and taking these points, right? If you follow that enough, you'll see that it's a dance of constantly making points and then taking points, making points, taking points, and that's the liquidity grab. So she got in again at 1027. So she was added to her position, felt confident about it. So she bought the dip right here a little bit, right? She's already in the trade. Buys a little bit more of a dip, gets back in. 1027 to 1032. So she got out. She got out right on this candle. Big push right here. Take your money, right? Exactly. Good job. You avoided all of this crap right here. Nobody wants to live through this. This is just murder on your mentality, right? Every candle, you're like, wait, oh, no, yeah, I walk away sometimes when I'm in trades like that. So we'll look at Cloud Surfer stuff here. He's got all his stuff marked up. Yeah, you can't have too many levels. Yeah, good job. Attention to detail. He's focused on what he's doing. And here's the other one. Right? Asia lows, New York AM highs, AM lows, Asia highs. So he's got his ranges. He's got his PD arrays. It's a little small for my old eyes, but I definitely see you're putting in work. Definitely. Good job. And that's something else we can do on this stream. If you've got charts and stuff and you want, throw them up there and show us what you did. We'll talk about it and praise you for the good, and talk about the bad. You got ticked out. You got stopped out to the tick. Yeah. You were playing the NFP though. If you got taken out by the NFP wick, you were close. You're probably close to a banger, but that's just the time I can't trade it. 39R trade. Yeah, pure pain. I know, brother. I know. Brian asked me earlier about the A to Z guide that we're doing. I guess I can kind of show you real quick, just a little tidbit of it. We're going to put out something that has some tabs down here, and it's going to be complete information. So everything a new trader needs is going to be on this tab. Instead of me using the Discord to put a bunch of channels and rooms and links and stuff that's hard for you guys that eventually gets buried, I'm going to put it all in a document that I can update. I'm going to give you the links to everything. I'm going to give you the documents downloadable through my Drive page. You're going to have everything, Here's the DR metrics, right? You're going to be able to have access to all this stuff. Or if you want DR, you can do DR. The DR playbook. Well, need to fix that link. The DR playbook will be in there. Everything you need as traders is going to be in this playbook. It's going to be very complete, very comprehensive. I'm really into the ICT portion of it already. Got a lot of good stuff going on. All these are downloadable, so you don't have to try to see it here. You'll actually be able to go download the picture and bring it up and have perfect visibility. We'll put your, the links that we think are the best for, getting your information. I've got ICT's list of where he thinks would be the best order to learn this stuff in. And then you go here to Tristan's Notion, and it's going to give you everything. So everything that's in there is, here's your different series. When you go over here, say I wanted you to go do the mentorship series, which is the one I normally point to. You go over here, bam. Takes you to all of the lessons, videos, everything. This guy did an amazing job putting this all together, and it's out there public. I'm not hijacking anybody's stuff or anything. And so here, this is cool. Let me show you this real quick. This is why ICT, to me, is the ghost in the machine, okay? I've gotten to where I'm making memes over this guy predicting price, right? So he made a tweet at 8:52 a.m. saying, and it's kind of funny the way he does stuff. It's like 44.93.75 ES, buy side juicy, right? At 8:52 a.m. This green line is 8:52 a.m. So he called that price before New York had even opened. In fact, it was consolidation. It could have went either way, right here. This could have just as easily turned around and went completely south. What did price do? Went right up to 44.93.75 and died. Died. Right there. Okay? Nobody else does this. I don't see anybody else do this. Okay? This is it. This is the guy that we're getting this stuff from, who says this is what the market does. I don't care if he's, thinks he's the Easter Bunny. I'm going to use this stuff. And then on this one also, this is amazing. I don't know how well you can see this, but same thing. At 4:12 a.m., he made a call on a price, which was back here somewhere. I don't know. 4:12 a.m. Yeah, at 4:12 a.m. he called 40.60.75, right? 40.60.75. He said, note that. He said that back here somewhere. Look what price did. He didn't just get a push up and a trade. He got a full-fledged, serious structure break and a macro move that was just incredible. To the very tick. I mean, hours and hours ahead of time. He knows the market. And this is, this is what I want to aspire to. I want to be able to do that. We're getting a little bit of a push over here. Let's see what happens. So now maybe we got our break. Coming into the end of lunch. This is either going to be the push up here to this liquidity. Very bearish. We actually got a market structure shift right here, or a brick structure. This would be another one of those places where if I wanted to, I was already in the trade or whatever, I might add to it because I'm pretty sure it's coming right up here. May not get there immediately, but I would test it with, a stop loss right here, low risk. I would have done it sooner. Like as soon as I saw this fair value gap right here form, I would have been looking for a retest of that. And when I didn't get it, broke structure, I don't even know that I'd wait for a retest. Just anticipating that move. Yeah, Waleed, I agree. I mean, some of that he talks about, I don't know. He acts like he does. Whether or not he does, I don't know. He may just have so much knowledge and so much ability to understand this market. The guy's, is a little bit, out there a little bit. But I gave the example earlier. If you follow chess, Bobby Fischer was probably the best chess player that ever lived. he was a little bit on the edge. I mean, he got to the point where he was saying some stuff that just wasn't, making a lot of sense, but you can't take away from his game because of that, right? He was the best. He had a level of knowledge of that one subject that nobody else could touch. And the rest of the time, he might have been, like I said, out there a little bit. John McAfee's another good example. John McAfee ran, the McAfee virus program. Dude's brilliant, billionaire, brilliant. Nobody knows that type of technology like him. He is the master. But if you're following him right now, he's got a show where he's like running from the government, wearing a tinfoil hat, and out in the jungle somewhere, whatever. That doesn't take away from the information we could get from him. So a lot of people have a hard time separating ICT's personality from ICT's abilities, and I don't have that problem, right? And I appreciate the fact that he put it out here for free. So I get on there and I defend him like nobody's business, because the dude, he's already changed my life. He's given me an approach to something and a positivity that I didn't have before. And if I end up, obtaining all my dreams and hitting all my goals, he gets, the lion's share of the credit. So you're going to see people talk about him. A lot of people don't like the fact that he's out here saying retail sucks and your indicators suck, and you're lucky if you're winning, and but from my perspective, a lot of that's also true. So I'm admitting that for myself. I'm not trying to extrapolate that onto everybody else, but that was true for me. Yeah, I know, Waleed. I've heard that same thing about the Enigma and the, but like I said, I compartmentalize that. Uh, it's it's not like I'm leaving my kids with him or anything, or I have to trust his rationality in any level higher than what he types at a keyboard. So, all right, so getting our liquidity push, nice. We'll see how high it pushes up on the NFP. Kind of riding the coattails of NFP. It's always a reason to push the market farther than it would go normally. So it must have been, somewhat good news for payroll and jobs and all of that. But you'll still always see this sweep. Even good news is going to sweep the market because it's not random. And then you get the big, manipulation, fake, and then distribution. Yeah, I doubt he'll watch this, but I don't think I've said anything that's irrational. Like I said, he has a lot of people that he's pissing off because he's giving this stuff away for free, and there's a lot of people capitalizing that are repackaging it and then selling it. And there's no way I could do that. Take free stuff and just spin it and say, here, you pay me this amount of money. I don't know. I guess at some level, there's people willing to do that because ICT can be hard to learn. And if someone is really, really, really doing a good job of condensing it and making it applicable for you and changing it to a level to where you can actually apply it and make money, okay, I can see that. Nothing wrong with that. You're definitely, as long as you're not taking credit for the stuff, you're just teaching it at a different level. So our time frame, Ryuk is saying there's some stuff to pay attention to. Right, so we're just now reaching the low of this, and kind of what I thought would happen, at least on the hour time frame and the 4 hour, was that these fair value gaps would get penetrated to some degree. If there was liquidity within them, I could see that being taken, but I don't see them being closed above. Not for the time of day we're at. I could see it bleeding up through here for a little while, doing some more consolidation, maybe a couple pullbacks, and then hopefully eventually a dump to capture all the liquidity that was created on this move up. That's sort of what I'm waiting for, is hopefully I get something back to the downside. And there's days where it does it. There's days where in the last 15 minutes of the session, it comes all the way back down and it takes this liquidity. So you only need a few of those to, convince you that that's a valid trade plan, and it helps you wait through this stuff right here. I would have got in on the trades Crystal was talking about, just either wasn't paying attention, or I'm too busy talking, and that's a lot of it too, is I'm talking a lot and I'm not candle by candle like I normally would be, but it is what it is. So yeah, our consolidation box has been breached. Breakout traders are in the trade. They're hoping to catch this tap on liquidity up here at the minimum. And maybe this is the one that the market gives them, throws them a bone. I'm going to give you a few points today, but the law of averages says I'm going to beat your ass if you stay in this for years. So. And let's see, Bartos says we're at DR top. I haven't been showing a lot of DR stuff while I'm in this, just to keep it. Yeah, we're at DR top. So we haven't even confirmed yet, which is a typical. So NFP created such a range on the push that it took it a lot longer to confirm up here, and it hasn't even confirmed yet. Normally a good DR move, there's confirmation within the first couple time buckets, 15 and 30, after the hour window is up. The farther it goes before confirming, then the less probable your trade is. So, but we can still use this once it confirms. We have as you advance and you want to add another tool to your toolbox, if you're going to start with the ICT approach, this is something you can definitely add later on. It gives you an ability to kind of swing trades a little differently. Gives you a few different areas for confluence, to look at levels. Yeah, it's a really powerful thing. I definitely recommend, at some point, you check out IDR, DRIDR, just as an advanced level of trading. It's worth knowing, I think. I like to have at least two things I can rely on. And I really got away from it because of the evals I was doing and the PA accounts. You can't trade the same way because of your drawdown. The strategy relies on, big moves, big retracements, and you sort of fading that drawdown, maybe taking a break even. But if I take a trade and it goes all the way up to 0.5 standard deviation, comes all the way back to the midpoint, that's 61, that's 25 points, right? And I can't take that kind of hit on my drawdown. Even if I break even on the trade, I lost on my eval huge. So if you're trading PAs and evals, DR isn't really going to be your go-to, I don't think, unless you just take profit, but then you might as well just do what we're doing over here. So why wait for an hour, 2 hours for the DR to confirm? If you're just going to take profit, take your high probability, classic model ICT trade and get out like Crystal did, and you're done, So like I said, we'll try to, maybe we get some of you guys that are, really big into DRIDR, we give you some time to stream, and as long as you're not showing live DR data, you can be just kind of going over what the basic, the free stuff would look like. I wouldn't have a problem with that, of us expanding into that a little bit to help people, because I know a lot of y'all are interested in it. But like I said, first and foremost, the priority is for the people that are barely knowing how to trade, or they're just not, or they're struggling. So we do have some, if you go to ICT Kraken, he's starting to mess with a model that really has promise. He'll wait, he's got his own custom indicator, and he will wait until, I think it's 11. He'll wait for price to come back into the zone here. And all he does is he go find PD arrays on the 5-minute chart. So the first, you have a PD array right here. You have a PD array right here. And he waits for price. He trades the PD arrays on the retracements that apply to the DR range. And from what we've been looking at, it looks really good. So it's another simple, free, high probability, potentially model that we can add to our toolbox. That just gives us, it's sort of another view on the market, but you're still using the fundamentals that we're talking about here. So it works really well together. So So still just up here tapping around up under here. So the people who were thinking, we're about to break out, we're going to scalp a point. We're going to do a 1-to-1, 1-to-2 trade right here at the very, very top. I've gotten caught like this. I know. It's just got to go there. It's just got to go there. When you're right here, the next candle is going to push, and you're going to get this big move. And you get in, and you put your stop right here, and you get stopped out. That's by design. They know where they're at. The algorithm always knows what levels it's pricing up to. It knows which reaction it's going to try to, generate in the people. And like I said, that's the only approach that makes sense. If you try to look at it from a random perspective, why is it always getting right up here and stopping? Why is everybody selling right here? Well, who's buying up here is what I want to know. Who's the dummy that's buying right up here? This is the supplemental liquidity providers. This is the market being pushed up to sell up here, not people buying because they think this is a great place to buy. This is what's the favorite stock market term? Buy low and sell high. All right, buy low, sell high. Buy low, buy medium. Why buy here, right? I mean, that doesn't make a lot of sense unless you're on such a time frame that you expect, a week from now, us to be 100 points ahead. That if you're looking at it from that perspective, maybe, but you're also going to push the market a lot more with the kind of money that those people are using. So again, now this has to be the time we hit, right? It just has to be. We're so close. You faked me out here. You're not going to get me this time, Mr. Market. Got my stop loss right here. I'm right under this fair value gap. Perfect place. Put a stop loss. Put a scalp. Whoops. Stopped out again. So I don't take the moves close to the line anymore. And I don't take the moves right after the line anymore. I'm waiting for a whole bunch of manipulation back and forth across these highs. If it's the final high. And this is the way it'll start acting when it gets around to it. If we see it come up here and start consolidating and take some dips, a couple more pushes, something like that. Normally once this high is made, it'll make at least a couple more. Very rarely are you going to get the high broke and then a straight market structure downside, right? Because everybody starts looking short right here, and it can fake you out plenty of times to get you to go short before it actually goes short. So a lot of caution when you're up around these higher time frame levels. So this fair value gap wasn't actually closed yet. Let's see if it closes. It's got 10 seconds. We'll see if it respects it or not. If we're going to go back up, we would expect it to. No, yeah, it closed below it. So we'll see. We'll see if it takes out this low. So yeah, the people that tried to scalp this again just got burnt again. And I don't know, that's their model. So they're, they've won enough on it to where they're going to accept this kind of stuff here. But like I said, I don't want to trade something that's 40%. Open DR went long. Confirmation. The DR open price went long. Yeah, if you're trading DR, you can do this up here. I mean, if we get a confirmation on the upside, you're looking at a minimum 0.5 standard deviation is a potential target. And you just don't know how much, retracement you're going to have to deal with. So if you get in and it wants to drop back, to the midpoint of the DR, you're going to fade a lot of points of drawdown before it actually does turn around and rip to the other side. So you have to be committed to that strategy, and you have to take every trade because it's a lower win rate, higher RR, but you can have strings of losses that are 6 or 9 deep, out of 60, 100, whatever. And if you're off the week when all the winners hit, then all you are left with is that few days you took those trades during a losing streak. So I think it's a great strategy. You just have to, that needs to be your strategy, your bread and butter for that very reason. Trade would appear for start of PM session if it consolidates through lunch hour. Yes, I agree. The lunch hour consolidation usually comes with runs on highs and lows, one or the other. And then the end of the day move will take out the other one. So we just took, the lunch high is pretty much taken. I guess maybe this is the lunch high, we'll say, because it ended at 12. Created all this consolidation, made a fake up here, a couple pullbacks, and do we extend? And judging it from, the available liquidity above, there are points, but they're not strong points. They're not like these type of points, real swings. They're just single candle. There's a little bit there. Yeah, I don't know. We'll just have to see. It can do that. I mean, I've seen it do things that made me jot down the market can do anything. Because I don't want to get pigeonholed into it has to do this, it has to do that. You're aware of what it does most of the time, but the one time you try to bet on it doing that is the time you might get trashed, and you should never set yourself up for a position where if it goes against you, it's going to hurt you more than what your trading plan is. If your trading plan is 3 to 5 points of risk, that's your trading plan. If you decide you think something, you want to get cute and you're going to drop it to 15 points to try to catch a 10-point move, just something off the wall like that. You see something in Discord, or you see something on Facebook or Twitter, and someone says, hey, it puts a chart up there that looks really juicy, and he's got this big move he's going to try to take, and you're like, hey, this guy looks like you know what he's talking about. I'm going to get in on his trade. I'm going to, triple my risk because I trust this buffoon. I've done that, and I don't do it no more. Right? I did that exact thing. I saw someone, kind of looked at his stuff. I was like, oh, he's got his charts all drawn up, and everything looks good, and he's solid, and he's talking about this big money. He's trading all these contracts, and I jumped in on this freaking trade and got my ass smacked. And I went back to his site an hour later, and the whole thing was gone. He took it down. Here I am with this big hole in my backside, and so I didn't do that anymore. I won't do that. Yes, right, Crystal, exactly. It's a mistake. You've got the stuff that works for you, and you're trading against you. Don't trade with or against anybody else. Learn from everybody you can, but develop your own way to attack this market, because it's going to have your personality on it. It's going to be what you develop it into be through what you learn and what your mental tolerance can be for different. You may not be able to handle the the drawdown that to put your stop down here under this candle. You might be a little bit tighter. You may not win as many trades, but your losses aren't going to be as big. There's not a lot of wrong ways to do the right thing. There's a lot of right things you can do that you're going to have flexibility with. So you need to be in the charts. You need to be in your back testing. You need to be studying, and that's how all that stuff starts becoming part of your trading character, I guess. You're adapting new habits, new personality in a way that is geared towards interacting with this market. Not anybody else, not, nobody but you. All right. So more consolidation. So if I would have took this one right here on this break of structure, what did I say that was? From 47 to 51. Okay, so I got my 3 points again on the scalp with a break of structure right here. Displacement, fair value gap, retest. Over and over and over. The fair value gaps that create shifts carry more weight in my eyes. I've got a note. I've got a note. Find my note. Lesson list. Okay, trust the break of structure. A break of structure fair value gap is good for a second touch. Okay, so when I did that, and I made a little image of it, here's my break of structure candle, break of structure fair value gap, good for a second touch. Okay, this is where I spend my time, not in the market, in the charts, because now I take this information into the chart, I make it on my list, I highlight it, and I get over here and I see a break of structure candle with a market structure shift and a fair value gap, and I wait for a second touch. I've identified that as successful. And if you'll do that, you'll find all kinds of things that aren't on my list, and I'll have things that aren't on your list. If we ever put our lists together, we'd be dangerous, I'm telling you. But that's the kind of stuff you have to do to be able to react at any time to what you see, because this, it sort of follows, this is the advanced model, but it's the same similar pattern. I just added that price can go a long way away and come back and still be worth a second touch. So maybe we were able to take a trade here on the first touch, and then it comes up, it comes back, takes a second touch. Well, I know that's high probability for a bounce. I'm going to add a little bit there, but on the second one, I'm going to put a very, very, very tight stop. I'm not going to risk all my profit on the second touch. The first touch is really high probability. Second touch also works, definitely worth taking, but you're going to manage it differently, considering your own risk management parameters. You're going to decide how that works best for you. So we're still just respecting this line right here. Just playing under this level of liquidity here. Lots of people getting stopped out trying to take this up. Okay, how many times have we taken a shot at this top? How many times have we tried to scalp this top? This is the third time now that people, and I wouldn't be surprised if it's the same people, because they know it's coming, and I know it's coming, but I also know there's going to be fakes before it gets there, so I'm not going to risk 3 trades to try to win when it finally does pop through there. Sometimes it might go on the second one, sometimes it might go on the third one, sometimes it might go on the 5th one, and sometimes it might not go at all, because if anything was 100%, we would exploit it. So all this is fake. We would need a body close below this point right here to be significant. I took a long here on NAS, 5-minute fair value gap, aiming for buy side liquidity. So he went long on a pullback and a 5-minute fair value gap on NASDAQ. So he's right here. Where's your stop at, Waleed? Uh, 15,522. So he's got a stop right here. So he's a couple ticks below the swing. He's banking on this fair value gap to hold. He's got strength. You're just so high in the level, and you're also in a order block up here. So I don't know, I think you've got plenty of, you got a good plan here for trying to just scalp that top, but I don't know how many points that is in. Are you doing minis or micros? Probably micros. Yeah. Oh, okay, indices, risking 1%. Okay. So he's got his, he's using his proper risk. He feels strong about a push. Are you looking for a 1-to-1 trade, or are you just trying to scalp that top? Because if you've got that big of a stop loss, you need that big of a target as well. So you're looking for a big push up to, if you're at 22, 1.79R. Okay. What's your target? Take partial. So he's going to take partial at the buy side, and then he's going to hold for HH, higher high. Yeah, nothing wrong with that. Like I said, it looks, we get a more extensive pullback here, but again, we're so bullish here. You expect these big pullbacks to shake these people out before we make our eventual move to the upside. So there's nothing wrong with this. It doesn't mean you're wrong. This is the market doing what we expect it to do. I'm going to go back to ES though, so I don't miss my trade opportunity again. Alright, so we're going to do away with the box. Box served its purpose. Body close, yes, got a body close below this, so we're looking, you know, that we got some bearish signals here, and we're still kind of looking at, you know, did our bullish energy, has it been expended, or are we just getting a deep retracement for the market to reaccumulate? Because if you can fib just this little level right here, right, we would expect something to come back for a retracement below the 50%. We would expect. So none of this is bad for a move up. You look at your, you know, your fair value gaps that get violated, things like that, at some point to determine most likely it's going to keep going. But right now we expect a retracement somewhere from here down into here somewhere, the ultimate or optimum trade entry for retracement on this price leg just right here. So every price leg is its own sort of universe, and price reacts to that universe the same way. So a pullback beyond 50% is where we would like buy the dip and put our stop maybe just a little bit right here if we were going to buy the dip. He took it on the fair value gap itself, so he faded enough drawdown to cover the pullback, which was smart. He's down here somewhere. That's a good trade, man. That's a good trade for sure. We know that liquidity is going to get taken. You gave it plenty of room. You're not really trying to scalp it. You're aiming for, you know, better than a 1-to-1 trade. So the scalpers are really what get beat up here, because they're just trying to get 2 points, maybe 2 points of risk, you know, and high, you know, big positions. They might have 5 contracts on that, and if that 2 points hits, that's $500. So you can, I see the appeal to doing that. If you know the market's going to hit a level when it gets so close to these, if you're already thinking smart money and you add the scalper component to it, and I've done it and I've had success, but I've also gotten burned, and it's just not worth it. I want to stick with what works the most and that is comfortable. That combination is important to me. I don't want to be one of these guys that looks like the guy from Back to the Future with the white hair, you know, running around, you know, just freaking out and spazzed, and because this will jerk your emotions. I've tore my hat off before, tore my hat in half. I've thrown a couple things. Yeah, so. And that's nothing, because I played Madden almost at a professional level, and I don't know how many controllers I broke because I was so competitive. Yeah, I spent more on controllers than I spent on evaluation accounts. Let's just put it like that. I won't say anymore. If you know how much a controller is, you can do the math. So I already know going in that my psychology needs, you know, I need to be really, really careful. All right, so now we're getting our nice push. We had our liquidity grab here. Came down, took this liquidity. And you always have to be trying to figure out, is it a liquidity grab or a break of structure? Well, this is a very weak break of structure. We didn't get a displacement candle through the structure break. We got, you know, good push here. Took this one out, but then it kind of died with this candle right here and this push up. So no reason to try to apply the model going short here, especially since liquidity wasn't taken at the top yet. What happened to my liquidity line? All right. There we go. So you can see how even on the fair value gap, there was a little violation here on the 5 minute. The bodies tell the story, the wicks do the damage. You always have to account for a wick through. If you're going to use a fair value gap, that's fine. It's strong, but give it 2 ticks. Right? 2 ticks would have put you right here. Yeah, 2 ticks still wins. And if you're already using 3, 4, 5 points or whatever, that extra 2 ticks isn't going to be what hurts you if you lose. But it might be the distance that saved your trade. So I'm a big advocate of adding a tick to a fair value gap. if this candle right here was my trigger candle and it missed by that one tick, you know how irritating that is to then watch it go for 2 hours up. Add the tick to the fair value gap. You know, when you see, either do it mentally or draw it out. You know, whatever it takes for you to do. I just put my limit order up there, and I know I'm one tick above, but that would be the one tick added to the fair value gap, and that gets you into the trade. And there's a lot of times, if there's enough energy away from you, you're going to miss trades if you don't add that tick. I think Jake had some success with that today. He was saying, I want to market that somehow. I think that's the only thing I've come up with myself that's, at least from what I've heard, is original, or, you know, fair value gap +1. I get hats for everybody or something, you know, for the Discord. Fair value gap +1. That's going to be mine. And everybody be like, what does that mean? It's like some kind of weird code or something. You know, you have to be in the know to know. Okay, Wally, good job. Stop loss at break even. So he's in a free trade right now. Hold on, let's see, all these questions. Mark, would you take this NQ? Which way, Kurt? Long? No, down. Not. You know, the first one I might have, like when it broke structure right here. Whoops, what happened? When it broke structure right here, that was a good indication of a move. There's a fair value gap created, came back up into it. My stop would have been, you know, whatever. I don't do NQ, and so I don't know what the equivalent of 5 points is, but I would have been at least above this swing, most likely above this swing. If I could have afforded it, I'd have been above this swing. But this meets the criteria for the move, right? You got a nice swing low, big displacement, body close under it, fair value gap retested, fair value gap violated, but swing protected. So, oh, you got smoked? Turtle suit. Oh, wait. Where'd you put your stop at? Dude, stop had to be above the swing. Well, again, it's NQ, so I don't know. That might be too much for NQ. NQ's point system is a little different. I think it's 20 bucks a point, $5 a tick, but it moves a lot faster, so it kind of equals ES in a way. So Kurt took one for the team, and we'll see what lesson we can learn. So yeah, you have to be aware of your, you know, everything that's going on. We've got a series of equal highs here across both time frames here. Obviously, if you have it across one, you're going to have it across both. But this is serious targeting here. When it does pop through here, it's going to pop through with energy. And I anticipate we're going to have a nice little move to the upside. The longer it consolidates under that line, and with also a relative equal high prior to that, tons of liquidity here already added to this liquidity right here. When it does burst through there, it could be, I don't know, it'll definitely go through that. You can see a single move that just jumps up right through it, and that's what induces me a lot of time to try to take this trade, is because I know just from seeing it that pattern, you know, the pattern repeats. This is what I expect, and the longer it goes sideways, the more probable this is. Whether or not it happens now, I don't know, but just for reference, that's something I noticed. Crystal said she did a little scalp there. That's fine. You're in the money, you know. Enjoy your day and make some more. Just make sure you got a nice limit set, and you're not going to put yourself in a place where the weekend's going to suck. Especially on Friday, folks, man. For your psychology, go into Friday green. Your weekend will be better. You'll sleep better. You know, your wife will appreciate you more. All of that, because you're not pissed off that you gave all your money back at the end of the week. So Fridays are really important for that. And then you come back Monday, you're not in revenge mode, you know. I play Friday just a little different just for that reason. Again, I'm trying to conserve my financial capital and preserve my mental capital as well. You got to look at it from both sides because they're equally important. You can't trade without money, and you won't have any money if you don't control your emotions. So when it starts kind of vibrating like that, all of a sudden it's been real slow motion, and now we're getting these big swings, real quick moves. Sometimes that's indicative of some more energy coming. I don't know if that's the macro taking over and getting involved, but you'll see a uptick in activity as far as how the ticks move and the candles are formed. Anybody else in any trades right now? Well, I lost my. How do I get back? There we go. No trades. Okay. So how many times have we taken a shot at this top? Right? It's cleaning up right now. All these people, and the big move down is because now everybody's getting stopped out, and they're selling to the market at a loss, which as a sell, it then propels the market down some. So every time they got up here thinking they were going to get a trade, big push down, big push down, big push down, big push down, huge push down. But I don't think it'll break this small order block right here. Fair value gap right here. I wonder why my fair value gap isn't showing. Did I turn it off on accident? Oh, I did, when I was explaining about what it looks like to have just a regular retail trader screen with no fair value gap. So it's coming up here. It's coming up here. There's no way it leaves all these equal highs. This wouldn't be a bad place to take a shot. Bottom of this fair value gap to the tick, right? It's random, but it rebalanced this inefficiency right here to the tick. Turn around, and then at some point we get our nice big push here. But everybody that's been trying to catch this top is really having a bad NFP day, and maybe that's why it gets such a bad rap. This combination of big moves and frustrating situations. I don't know, Crystal. I imagine if somebody wanted to pay somebody enough, they could make a custom indicator for that. As bearish as this was, it didn't create a fair value gap. So, it looks like a big push, but it didn't create the fair value gap, so it's not that strong. Took out another smaller level of liquidity right here. Tapped into this level, reversed. We still got this order block down here inside of another fair value gap. So when it does turn around, we'll expect probably a pullback and a retracement out, and then a deeper retracement, hopefully. That's what I'm trying to trade. That's what I'm going to be looking to trade. I haven't deviated much from what I would do if you guys aren't watching right now, so that's comforting for me because I wasn't sure how this was going to affect my actual ability to trade. Okay, so we might be done playing games now. And we push. And we push. And we push. So, and we push. There you go. Now, I'm not going to want to say I called that, but I called that. There we go. That's exactly what I expect to see happen after all of this. After all of this, all these fakes, now we're moving. Right? All the people that went short are now selling, or their shares are being bought, which propels the market higher. And that's the market now accumulating their shares after driving them out. First it creates them, it brings them into the market, then it takes them out of the market. That's all this was. This is what the market does. If you think it's random, there's absolutely no way I could sit here and do this. There's just no way, man. I mean, I've looked at what this might do if it was random, and over the course of time, that's kind of why I trade one instrument too, because I know ES. I mean, I know ES, you know. I'm sure NQ is making similar probably moves, you know. I've got that on my screen. NQ is also pushing, but I'm able to better calculate the size of the moves. Like when I put that one line up there, I knew that was a first target push, just because I've seen it do that so many times. All right, so now this line moves. We create new high. And more likely than not, this is not the end of it. We might get a little bit of this activity, a couple pops, and we'll start getting some fakes down if it's going to turn. We'll start getting these fakes down. I won't take the first break of structure trade that I see. I'll wait for a one of those to then come up and form a lower high, sorry, and then break structure again. On a day like today, that's the way I'm going to trade it. I need to see a lot more than I would on a normal day because of the energy of these moves. So it's good to kind of be able to modify your trade plan to adapt to the circumstances if you're going to trade days like this, because it's not the same. Levels get broken that maybe normally wouldn't, you know, and you get more swings, you know, more energy, more, you know, just it's a little different. So I would need to see, I'm not very good with this drawing tool, but something like, I'd want to see something come down. I'd want to see a break of structure, then a lower low, then another break of structure with a fair value gap up in here somewhere that gets retapped, and then I get in. So that's what I'm looking for. I'm looking for a high to be made, for a fake break of structure, then a lower high to be created, then a true break of structure with a fair value gap. That's my entry model for this day right there. Until I see that, nothing else has my interest. That's basically just the way I approach it. I know what I just explained is a high probability setup. It takes into account the market manipulation. It takes into account a solid fake. Now, if it gives me two fakes, well, I'm going to lose. I mean, I'm trying to give it enough room. I'm trying to find the middle ground between being able to take a trade and just saying, well, it's got to do this. You know, at some point, yeah, maybe it has ran 3 or 4 fakes before, but from my experience, if I give it that one good fake market structure shift and it comes up and makes a lower high, if it makes a higher high, then that changes the game plan a little bit. But I'm still bearish if it comes up and makes the lower high and then breaks structure again. So I'm looking for the second structure break to get in on. And depending on how late in the day it is, if it's right up close to the end of the session and I only get one market structure shift or break of structure, then I'm going to get in on that one. If it's approaching the last 30 minutes, because then it doesn't have enough time to do the fake, do all the retrace, come up, come back, do it again. The market's sort of on a time limit as far as when it has to hit these levels and book these prices. And that's why you see such violent moves in the last 15 minutes of the session. I mean, we all know the market's going to open back up in an hour, so what's the hurry, right? If it's going to tap that level, why can't it open up in Asia and go tap that level? Well, you don't have the liquidity, you don't have the volume. It would look highly suspicious if the market kept making these huge moves in Asia, because we all know that's a downtime, and it would draw our attention to the fact that it's manipulation. So in order for it to accomplish its goals, you're going to see more often than not that big push the last 15 minutes. So I'm going to start looking at the tick grid a little bit. This is maybe something we can talk about. Not so much on the 1 minute. Well, we'll look at it. I'm going to put it up on both. Okay, so this is a candle by candle representation of the difference between upticks and downticks on the S&P. They use it a lot in DR. M7 uses it, and it can tell you when the market, like the index is supposed to be mirroring this right here. Okay, this is the S&P. This is all the stocks combined and the movements of those stocks cumulatively. You know, if you added it all together. So when the market starts doing one thing and tick grid starts doing the other, you get a divergence similar to we would use when we're looking at this. And you've got NQ and ES. You're looking for them to do something different. When it does something different, that's an indicator that there's manipulation and can give you a signal on maybe something that's more bullish than you would already or would have assumed. Same thing with this. If you get a big push down here, but the market keeps going up, eventually this is going to follow the tick grid. It has to, because all the stocks are dropping. And it can tap this level, but if this is dumping down here, it's going to take this liquidity, and I'm going to expect it to dump and follow the tick grid. The only reason it would keep going up is because the the algorithm is taking over the pricing. It doesn't care what stocks are being bought or sold. It's on a buy program to move up, take liquidity, and then it's free to rejoin the movement of the normal market. And you use that to kind of, same thing with comes down here. When it comes down here, you see this is a low point here, and yet we were moving up, right? So here's low, we're moving up. This is moving down, this is moving up. That's manipulation. So this is NFP reaching for liquidity. The stocks aren't as energetic about going up, right? They're saying, such and such day, Apple had earnings, this company had earnings, whatever. So cumulatively, you can learn what the index should be doing, but then when you look and see what the index is actually doing, we could have made a prediction that this liquidity level was going to be taken just by looking at the divergence from what the tick grid showed. At any point, you know, 3 or 4 candles in and this is going down and this is still going up, you know the market's being driven somewhere. And that's kind of how you use that indicator. That's a good one to have. It's just called tick grid. Tick grid the master. I don't know. It's free, so you know. It works on the. You can use it on the 1 minute, but I don't trust it as much, I guess. It probably shows the same thing. I mean, yeah, it's still going down here. Going down here while we got this huge push up, right? So it was valid, very valid on the 1 minute also. And right about here, they start to work together again. Little dump here. So it came down a little bit with this. See how this one, it actually almost swept down here. This was nowhere close to sweeping this low. That's kind of what a divergence is. Like if NQ comes down this far and ES comes down this far, you know NQ is about to take off that way. There's no way NQ is going to come all the way back down here before catching up with ES. So that's how we use those. And those are powerful tools to use, and it's something you definitely want to. I'm going to put it on the A to Z guide. There's going to be some area there for discussion of divergences and maybe some examples of how to use tick grid. I'm really going to try to put everything in there that I can. I mean, you're going to have so much information in there, it's going to be ridiculous. I want it to be like the new trader Bible or something, you know. And you know, for experienced people too, there's going to be a lot of content in there that's beneficial. But that's sort of my way to try to get us all on the same page. You know, right now we're pushing people and pointing people and saying, read this document and go to that video and check out this series. And we're having to, you know, give them places and stuff. I'm just going to say, go to the new trader tab, line 17, and that's where that link is, or something. Some kind of way to really control the information and use data in our favor to uncomplicate things as far as the training process and the growth and all that. I think that'll be a good resource to put out. So pulling back into these fair value gaps now. Here's our new high. It's still early enough in the day by far that this is going to be tested and broken at least once or twice. That's just my guess. I always have to qualify that, because if I don't say that's my guess, or then next thing you know, I'm on Twitter with somebody saying, yeah, he said it was going to turn around, or he said he was going to test that again, and it turned around the rest of the day. So I don't want to be that guy that's getting his words used against him. So I try to qualify everything by, this is what's most likely going to happen, this is what I see happen often, and this is what I would build my trade plan against or around, while acknowledging the fact that nothing in the market happens 100% of the time. Just be right more than you're wrong, and you can make more money than you know what to do with. That's how you break it down simple. So I'm gonna get rid of the tick grid. Kind of look at where we're at on our entire time frame. So good to know. We've got fair value gaps that we tapped into on the 15, the 30, and the 60 still. I was suspicious of whether or not we could body close above this, but with that push and knowing that we're going to pop through here a couple more times, it could be possible. And if that's the case, then the next level would be on the game plan. But until it happens, we're still trying to see. We're in wait and see mode. We could fib this one on the daily and use that as an intermediate target for what happens if we break this one. Then we've got a level here we can be paying attention to that maybe we don't see in here because it's empty space, but we want to know it's there. So we fib that real quick. And we've got a level at basically 69, 45, 69-ish. Oh. Well, where'd it go? It didn't sync for me. There it is. I didn't really want it on all levels, but it's up there. So that's an intermediate target. We know that's the middle of the daily fair value gap. If we don't see anything else in between, we expect it to maybe close that gap. Look for a reaction here. If it makes through here, then we have the top of the fair value gap. Just look for a body close. Obviously, it's not going to go that high. If that's just the midpoint of the fair value gap, you need to be up here somewhere. We're not going to close that today. I'd be surprised if we even get to that, but it can make a couple pushes, before it makes its eventual turnaround. And again, it's just being aware, just having points on the chart that you expect reactions to, so that you can make snap judgments based on what you see, knowing that you're interacting with a level that you've identified as something that price might actually respond to. So this is always a good place for me to try to buy the dip when I know that this, serious new high was just made, and I expect it to get tapped a couple more times. I would definitely take these down here with very small risk, a couple points. I'd wait till I get a good push down. A lot of times I'll wait for something to wick, and that's sort of a signal. It's a little stop hunt. You get the little stop hunt, put your stop, one tick below that stop hunt, and if that was the end of it, you caught it perfectly. It's a good tight stop, high risk reward trade, because you're coming all the way back up here. So 54, there's my 3 points. I want 3 points over and over and over. 3 points is $3,000. On the normal moves, down here like this, I'm targeting my normal 5 and hoping to get a lot more. But up here, playing around with, I'm still sort of following my idea for the most part, but that's something um, if I'm having a really good day and I'm up, I'll take more of these with real small risk. Just kind of like what Crystal is doing. She's trying to leverage her wins into a little bit more wins. Nothing wrong with that. Like I said, as long as you stick to what you're supposed to do and not trying to get something back or trying to rush and beat some goal or something like that. You're making good calculated decisions based on what price is actually doing. It has to be based on what you see on the chart, though. It can't be subjective or based on something else that has nothing to do with what we're looking at right now in these candles, because that's where you get in trouble. All right, I know I'm definitely not going to get a trade here in the next 5 minutes, so I'm going to take another 5-minute break. If one of you guys wants to, I don't know if Jake's still in here. Kurt, if you want to talk about what you see, if somebody's got a chart they want to throw up there or something, I'll be right back. All right, I'm back. Okay, so we did get a nice push. Busted that high. We'll line up. I really hope that seeing this encourages you that this isn't rocket science. I mean, I'm just following the same sort of pattern, you know, looking for the same things. I got one simple little plan. The anticipatory ability to not get faked out, I think, is one of the biggest benefits that you get from Shark Time. I've had to been faked out enough times to make notes about it and say, okay, well, it seems like this happens a lot, and then it becomes part of my, part of my plan. I adapt to that. And little incremental victories, being able to not get trapped so many times, those are losses that I'm not taking anymore, that I used to take. So my win rate goes up, my profitability goes up. Every time I identify some little thing like that, little quirk in the market, and adapt it to my plan, that's me getting better, just over time. Yeah, Waleed, you got to within a point, huh? Right on. And that's why you put your stop loss where you do. I mean, there's nothing worse than getting stopped out by a couple ticks and, and then price turns around. That sucks too, but you definitely got to find that happy place for yourself. You know what your, risk tolerance is going to be, how much you're comfortable with, and you got to use your, use your emotions too. If you have a stop that causes you problems and makes you anxious and you're, overly concerned about it, then you're too much risk. You got to size down a little bit. Every time you go into a trade, throw that money away. That's really the approach you need to take to do this long term. Is you, and I've heard this from someone else. This isn't my thing, but this guy that I was listening to, and I don't remember who it was. He said, assume every trade you make is going to be wrong, pretty much. Until the market proves you right, you have no idea what it's going to do. So plan accordingly. That the risk that you're taking at that time, there's a good chance you're going to lose it, and it'll affect how much risk you use. And if you're not comfortable with the amount of risk you've got, then you're using too much. You don't want to get stopped out and be like, oh damn, I can't pay the light bill, if this trade doesn't work, or something like that, because the pressure that puts on you will completely dismantle all your good habits, all your good rules, all of that. So risk management has to be a really high priority for your mental portion of this game. And to me, it's a game. I mean, that's why I named the Discord the trading game. That's why my YouTube is the trading game. I played video games a lot as a kid. I was, so for me, this is computerized stuff, is colors and stuff moving and all that. It's just it's like an adult video game to me. But I do play to win. I mean, that's the thing. We're playing to win. We're not trying to give our money away. So getting a lot of respect to the low side of this fair value gap. Still bullish. Got a new high up here. Early enough in the day where we still anticipate, maybe another pop through. Higher time frame, verifying. Still can be bullish. No problem. We're going to bounce out of this fair value gap. Possibly carry us up through this one. We did bounce off this fair value gap. We haven't hit consequent encroachment here yet, so no reason to think it's not going to continue up. That's no longer valid. That's no longer valid. Closed this fair value gap. If it closes, we still got like an hour before we would know for sure, but and reaching up here, so haven't technically closed it yet. Okay, now it just closed. Yeah, it's right at the precipice of closing that fair value gap. We'll see what it does. Pretty sure it's going to close that one. I'm going to mute somebody. Had to mute you for a minute, Kurt. I'm not sure what's going on. I'll bring you back in a second. All right, so there's your little stop hunt for this level of liquidity. It repeats over and over and over. Liquidity is built, liquidity is taken, new direction. So if I was going to play this, one tick below that stop, targeting this level of liquidity, 58 to 60, 75. By the time it comes through it, there's my 3 more points. And I would have waited for at least to break here, and then I would have made a judgment on how far I thought, you're not always going to catch the very last bottom tick, but if I was going to say I expect it to penetrate a little bit, maybe I go a couple ticks, I see that, I take the trade. I mean, that's a good place to take the trade. Give it a little bit of room, half the distance, make it a 2-hour trade, and target this level of liquidity, because we know this is where it's going. It came up here, turned around, induced people to go short. Yes, JP, I do use that. It's not. I was just kind of show people what's available as far as another indicator. I will use that though for sure. Just like the NQ ES. I used to have YM on there, but I took it off. I was talking to Kurt. He's the divergence guy. He's got some good stuff in there. Kind of explaining that and breaking it down. And YM is more of a distraction. It's just more noise. If you just watch NQ, they're more paired because of the stocks. They share more stocks in common. NQ and ES do. No problem. Kurt, are you done? I can bring you back. Yep. Okay, we're good. All right, so we'll see what kind of push we get through here. Sometimes it'll stop right there and come back. Wouldn't surprise me a bit. A lot of the YouTube videos and stuff on trading strategies, they do breakouts and orbs, opening range breakouts. They teach you to, take the trade as soon as it pops through, an old high or low. Scalpers are going to be trying to take trades when it gets close, so. If it does come back, then we've created an equal high, and equal high is a stronger target, which then would increase my belief that we're going to tap it again one more time before the eventual push down. If you look back now, we created just a ton of liquidity, right? Every one of these lows is big money for the market makers, banks, hedge funds to drive through all these orders so that they can purchase them and then carry the market to where it makes sense for them to then sell them to make the most money. So we've got a couple, higher time frame things. Everybody's really been waiting for the big, we've had quite a push here in the months, right? We're really due for a pullback that's going to be substantial when it comes. I mean, some of these are, like COVID. If you go back far enough, on this chart, you can see You can see the financial crisis. You can see COVID. You can see 9/11. I mean, you know, 9/11. What would that be? 2001. I didn't go back far enough, but anyway. Because of the economy and inflation and the dollar and everything else just being so, poor in the last couple of years, the fact that it's done this over this period of time is really surprising a lot of people, and it's really breaking the bears because they're highly invested in going short, and every opportunity they get, they're expecting this huge push, and they're going to capitalize on that, and it just hasn't come. So it's sort of funny. It's the game between the bulls and the bears. They talk smack about each other and how they're reading the markets, completely wrong. And if you're bullish right now, you're crazy, and you're about to get, this is just a bear trap or a bull trap, and they go back and forth. That's their. Some people just prefer to be short in the market, and just the opposite too. You got people that are going to want to trade the trend, and they're bullish no matter what until they see something that drives them bearish. So, kind of got two different camps of people at that level. Okay, still no. I think one of those lines I had was the consequent encroachment. I got rid of it, but we'll see. So only in the 15-minute do we see that we're in a, 15-minute and the day. Gives us, reason to know that this one might get broke, but this one won't. So there's no way we take it up to 90 at this point in the day, but we could very easily go up here and break this one, take out the high we just created. I lost my line. So yeah, we got up there, we tapped it, we did not break it. So all the people who went in heavy right here with 5 contracts trying to pick up this 1 point, that's all they needed to make hundreds of dollars from right here, or make $1,000 with enough contracts. Got right up here and then got crushed, because holding 5 contracts, 10 contracts, you can't let it go very far. You've got to put such a tight stop loss. And there's people that are dedicated to that strategy. There's a lot of them, because it's quick, fast money, making this little bitty move. You go in really, really heavy. You're only looking for a few ticks, and you get trapped. I got my ass busted doing that. I thought for sure it had to go up here, and got in heavy, and it made it right here. And right here, I'm like, come on, I just need 2 ticks to make a few $100, and I'm out of this trade. And then it turns against me, and now I'm hundreds of dollars in the hole, and damn it, I got to get out of the trade, because for all I know, it's going to rip through here and liquidate my account. You don't know. So the fear, we're always dealing with greed and fear. Here's the greed that gets you to try to take this move, and then here's the fear that pushes you out at a loss. You just barely get stopped out, and then the market goes and rips the other way, but you didn't know that, and you couldn't withhold that kind of position and that kind of stress, and you were so uncomfortable that you sold right here, and then the market comes back around and goes in your favor. That's where people say, man, the market's got my number, man, it does exactly the opposite of what it's supposed to do, etc., 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 because they're expecting it to be random, and they're expecting just something completely different. Excuse me 1 second. All right, sorry about that. So another drop. Again, not a terrible place to get in. A little deeper drop. Did not close below the consequent encroachment, so still bullish. Expecting this high to be taken. And there's times it does things you just completely don't expect to. I mean, and that's when you just, that's why you have low risk. If I was going to take that trade, realistically, on an actual retrace, if you fib it and do the, leg to leg, and you look for the 50%. So we're at the 50% of this leg right here, from this low to this high. We tap just below it, which the market will generally, on a retrace, tap into discount before then returning the other way. So discount at a minimum. So if you're going to try to, fade a scalp right here, you'd wait for it to at least come below minimum. Give it a, see what happens here. The lower it comes, the better. If you body close under this fair value gap, not a great sign for a turnaround, but still, optimum trade entry is down here somewhere. So we're not thinking reversal, we're thinking retracement. If it comes down to here, now this could be, the nice market structure shift fake that I talked about. There's your optimal trade entry, there's your stop hunt, tapped into the fair value gap. Real strong sense that could be a turnaround, but doesn't mean it is. But that would be statistically and, algorithmically a place we'd be paying attention to. Let's put it like that. But we definitely got the market structure shift, but we didn't get a fair value gap. So we got a little one here, but it's not candle close yet. So it doesn't count until it closes. We got 43 seconds before this closes. So we can't count that as a fair value gap yet. Pow. Now let's see what happens. Now if it rips all the way through here, obviously we missed the move, and that's part of the game. I expect, like I say, equal highs to get taken when they're up there. I don't like trading against that, but I also have a note in my thing. Let me show you the note. Lesson list. Relative equal highs and relative equal lows are not guaranteed to be taken even when close. So I plan for them to be taken, but I recognize if I see a strong enough signal that then I change my bias and I reapproach the market with that in mind. So still got a fair value gap up here. If it retraces, I'm still not buying this as a full retracement yet. We'll see what happens. Because on the 1 minute, if you do it again on the 1 minute or on the 5 minute, right? And here's why multiple time frames are so important. If you do it now from the 5 minute leg, really we just tapped into discount. Okay. So this holds more weight than this because it's a higher time frame. So just because I saw this over here, I'd verify over here and see, okay, well that's good on the 1 minute, but let's see where we're at on the 5 minute. Okay, we just tapped discount. We're in this fair value gap here. Do I really want to go short over here? Not yet. Not yet. Because I'm still expecting this to be taken. We're early enough in the day. I hate this indicator. Oh, that's not the indicator, that's the fib. Never mind. I don't have my IDR box. There we go. So this is sort of the end of the day. I use this box sometimes just to tell me how far I am away from, you know, the end of the day and the session and all that. So I'm still kind of bullish. We've got 3 hours. It could cover this distance in 4 or 5 candles if it wanted to, and I've seen it do it. Still, you know, kind of hovering right here. Energy seems to have been expended. Getting consolidation now. So it's rally, drop, rally. Well, it's rally, it's base, rally, base, rally, base, drop. Rally or base, rally, base, rally, base, rally, base, drop. Now we're going to base right here, and then we're either going to rally or we're going to drop again. And taking everything into consideration of where we're at right now today, time, you know, equal highs, respecting PD arrays, higher time frames, all of that. I believe it had to come down from here because we were in a 15-minute fair value gap, so that's not unexpected. But now we're bouncing into another one. We're bouncing into another fair value gap here. So yeah, I mean, I don't know at what point, how far it would have to go down before I would say, okay, most likely that's the run, you know, for the top. But we're not there yet. It would have to come down here below the optimal trade entry, I guess, because you expect the retracement to be in this 70 area. It's perfectly acceptable for a retracement and not a reversal. So we're not even close to that yet. And now we're starting to get a little bit of a, you know, if we close above this candle here, then we have a small break of structure. If we can close above that candle. Come back here and close below this candle, then that's more bearish. But right now my mind is on this 5-minute area here. So if it closes much beyond that, then I would sort of start thinking that maybe it's headed on down. There's no order blocks here on the 5 minutes. Just this fair value gap. So it kind of lines up with the bottom of this fair value gap too. So if you get a close through this fair value gap, through the optimal trade entry on the fib, then you have a good reason based on price action to start looking for, you know, a pullback, then another big push, a fair value gap, a retracement into the fair value gap, and a trade opportunity. So that's what needs to happen for me to start thinking short at this point and change my mind from thinking, you know, the way I was thinking before. And we could get just a, you know, a huge push right here because all these people going short, they see the straight breaking structure right here. And I mean, technically this would be, you know, this would be our model on a normal day. I would have gotten in probably here. But because NFP day, and I'm really just waiting for I'm waiting for all the energy to be expended and then to push at the end of the day. If it happens before that, then it is what it is. But that was kind of my plan going into the day, and I want to see if that develops. There would be nothing wrong with taking a short here. You're in premium, or you're in discount for a short. If you look at the longer leg, you know, if you fib the longer leg, the sort of the session leg, you're looking at that. And you can take a short anywhere above 50%. So perfectly fine to take shorts up here based on the criteria we already had. You wouldn't be wrong at all. You got several opportunities where, you know, swings were broke structure there, break structure here, break the structure here, fair value gap, retest, and if it goes for 3 points, they need to go a little bit lower, but that would have been a good trade. And I'm not going to say, if I wasn't live, I might have already taken this one. But because I told you kind of what I'm planning to do, I don't want to be going against my own, what I'm saying my plan is. That's my plan. But when I'm not having to sort of dictate my plan step by step, it's a lot more flexible. I can be like, well, this was my plan, but now I see this, and I'm going to change it and do something a little different. But this was a solid signal. So we'll see how it plays out, though. More consolidation. It's just a stepping stone to the next move that the market makes. And you notice whenever it goes from, one base point to the next, there's an energetic move, and they usually leave fair value gaps. And if you're catching the trend, those energetic moves always seem to, lead to positive trades. So that's why I have the advanced model, because I don't need the same criteria. I don't really need the liquidity raid. Like this wouldn't have been, maybe this is a liquidity raid here. It took some break structure here, but I wanted something that I could trade trends and not just reversals. So I've got the advanced model is geared towards trading these trends, and then the classic model is more towards waiting for these outer external liquidity levels to be taken, and then trade the reversal off of that. So I would say until this fair value gap gets violated, we're still bearish based on this move, but I'm still bullish based on the fact that we're hesitating here on this fib here for a possible just a little retracement and then a continuation. So where do I have that? Like right here? I guess you could go either. Yeah, that's sort of the first swing point. Any of these would work, If I do that one, it's not even to the 50% yet, and I wouldn't even be looking for a short. So you have to be careful that your bias doesn't affect where you put your fib. If you're looking to go short, you could put your fib on this swing, or whatever, and you can change what your entry would be. So use your normal rules. That's where I would normally fib it, and then I look and see, did I meet it? Did I violate it? So we haven't violated. We haven't body closed below the 50 yet, and this is where I'd have to hit to say, okay, short, based on this move over here. It doesn't show up the same way on the 5. You don't really have a body close below this swing point. What's that, Crystal? Taking a sanity break? Nothing wrong with that. You got your money today. I'm jealous. When am I going to get paid? It's all good, though. And we're like 4 hours into this. I don't even know how to do this on a... I hate to put a 4-hour video up there and expect anybody to watch it. I mean, I guess that's why I need those notes where I can put the time, the timestamps in on it. I would have liked to got the timestamp on a couple of those box moves where we sort of were able to predict the breakout and the fake, and then definitely the push through where I put the line up there. I think stuff like that visually makes a big impact on people when they're trying to watch and get an idea if you know what you're talking about or not. If you put something there ahead of time and it gets, hit just right, or, whatever, those sort of validate the idea of this style of trading. It's not me. I'm just saying that this style of trading gives you the ability to sort of make those anticipatory moves. That comes with the style of trading, not anything I'm doing other than sitting here long enough to see it happen over and over. So liquidity taken here. Could be a little mini stop hunt before a push back up. If I'm trying to stay bullish, that's what I see there. It doesn't mean that's true. That's just what the market just told me from that liquidity grab right there. So you can see also on the 1 minute, we've got body closes under the 50%. On the 5 minute, we do not. So what that is in 5 minutes, it pushed down, but it came back up, and this is just the wick. So this is the wick. That's a good way to show it, actually. Okay, so this corresponds to this right here. What you're seeing right here is actually this on a bigger time frame. And that's why this is so important to understand how they react together and the interrelation between many candles on one time frame versus a wick on another. What you think is a body close below this might induce you to go short, but then you look over here and you're like, well, wait a minute. On the more substantial time frame, I don't have a body close, so it's not as strong of a signal as I think it is. And that's why, if you're taking that into consideration, that can help you save a trade, or maybe helps you make a trade. I don't know, but it's good knowledge to have. I think we're still within striking distance. We'll see. I'd love to see it push back up here with some energy. Maybe catch this next macro. I don't have the time frames here on me, but seems like it's on the 10s and the 30s, 20-minute macros or something like that. So still kind of bouncing out of this fair value gap here. And this is a 15-minute fair value gap, so I really, I'd be surprised if it just ripped right through it on the first, I mean, it touched it, came back up, touched it a little deeper, but there was really no, push up. So also on the 30-minute, so we're in a 30-minute fair value gap too. I'd be real surprised if it doesn't respect that. But when you get to the top of the run, you can expect that to happen. Eventually, you're going to get to the top, and whatever PD array you have below it is going to get disrespected right away. So you have to expect that also. If this was the top, then this won't hold. Obviously, it can't, because it's going to move down. We're still trying to see if we can get a body close above the consequent encroachment here. But we would need, 39 more minutes to see it. So this candle can do a lot in 39 minutes. So next kind of point of interest, when you see something get near the halfway point, if you just want to add some strength to your analysis. All right, I'm looking to see if I get a body close below the 50% on the 30-minute. It might be more than a body, it might be deeper on the 15-minute, but the 30-minute is going to hold more weight than the 15-minute. So the higher the time frame you have, the stronger the signal it is. But this is going to be another 8 minutes before we can get a read on whether or not, we're really going to close below that. And a lot can happen in 8 minutes. Go back to my, okay, so yeah, we're, I don't know how that got back to there. Oh, I got 2 fibs there. No wonder. All right, that's my original fib. Okay, so body close below the 50, tapped right into the the 70 would be actually down here somewhere, I think. So yeah, we'll see. If we get a close below the circle. Now this could be also the fake too. So we've got our drop base, maybe a drop, or maybe a fake and then a rally. Liquidity was taken here. You've got liquidity equal highs up here. If the market wants to reach for these equal highs, I would say now is probably the time for it to make its move, since this liquidity has been taken. Unless it's going to go down and take, you never know how many steps it's going to take till it gets to the bottom. I mean, liquidity was taken here. People saw that, went long, got stopped out. Liquidity was taken here. Same thing. People went long, got stopped out. Liquidity was taken here. Got some candles going up. People got in long, got stopped out. Eventually, you'll get to the last one, and unfortunately, there's no set number of times that it's going to play this game before it eventually rips to the upside. If that's where it goes, I don't know. I'd be kind of stuck if it doesn't, because this would be real late in the game to try to take a trade. If I was going to take it, this would have been my opportunity to take my setup. But again, I'm not sure if that's a retracement or not yet, because it hasn't come down deep enough. I would have liked to see the fair value gap up here somewhere, a little higher, to where I could, put less risk on it. This little one is at 57. I might have could have done that one, but it never got tapped. So even though it made the fair value gap there, I never would have got an entry. So I would have had to fall all the way back down to here, and from here, 54. Now we're over 6 points, maybe 7. So we're just kind of watching this line right here. Bam. I would have loved to have been in that trade, but it is what it is. Came down to the tick on a fair value gap. Closed all these. 12 seconds left. Created another fair value gap, another drop. There we go. Yeah, so that's the move. I mean, but we still got 2.5 hours too. So what can happen in 2.5 hours? So takes that out. All the lunch stuff's gone. Now you start looking at your bigger leg. Yeah. I still don't trust this. I just don't. I mean, all this push up. For the end of the day, I can't see it dropping all the way back. To me, that would make sense, but that doesn't mean it's not possible. I mean, if the news kind of started off, indecisive, made a push. What caused this? I don't know. I mean, this was the news here. So if you were good enough news to get up here, why did you tank back down to here? And then if it was bad enough to overcome this good, why would you go all the way back up there? That's why I think all the news is just BS, really. It's just a reason for huge liquidity sweeps in the market. Because bad news should be bad news, good news should be good news, and it's just carry the day. Yeah, so definitely now very, very bearish and violated fair value gaps on different time frames. Bouncing out of these fair value gaps here somewhat. I guess when we were kind of looking, so my overall mindset was bearish from the 4-hour chart today because of this break of structure. So again, I might have let that bias of needing to reach this area here stop me from taking the trade I should have taken here. And even though I've got it as a lesson list, it's still very hard to overcome that bias because we know, everything's predicated around the market, reaching for that liquidity, and I see it as a strong liquidity point. You saw how fast the move was down. That's by design too. That's to keep you from being able to take advantage of it. Once it's going to break a major structure, it shoots through it so fast that you don't know if it's a continuation or a stop hunt. There's no way to responsibly take that trade at that point. That happens a lot. I mean, it's almost like they don't want to give you an opportunity to get in. Structure was broke, fair value gaps violated. Now we turned our bias bearish, and it moves so fast and so violently that 10 points are ate up before you have a chance to say, oh wait, where's my stop going to go? And none of that. So a very wide range of consolidation here. Yes, Herman. Per ICT news, are only a trigger for the price to go wherever it needs to go. That's exactly right, and that's what I see as if you didn't tell me that, that's what I would assume by watching it, because it doesn't make sense based on what I think should happen when you get good news or bad news, the reaction. But it sure is good for the market as far as being able to take out and create these huge levels of liquidity that injects, millions and billions of dollars into somebody's pocket. So, and it's no surprise that these events are scheduled the way they are. Like NFP is, whichever Friday of every month. FOMC is the same time of day on Wednesday. That takes a lot of the randomness out of it, and almost makes it like you could schedule around that and plan a path to say by this day we know NFP is going to come, we've got these levels we want to reach, we're going to manipulate, we're going to take this out and take that out. They can almost forecast how much money they're going to make by the end of the week by looking at the levels and knowing what they're going to do on Friday. So again, that's just what I would do if I had that kind of control over the market, and I'm not even that smart, so I'm assuming they're, I give them all the benefit for having all the brains, all the people that are educated, and all the supercomputers and AI and everything else to try to make this stuff work for them and against us. But we've got our little edge, we've got our little trading plan, and we've got our method of taking high probability trades, so we're not the ones that are going to be, picking our ass up off the ground every day. We're going to make money. we're probably due for, well, we got a little consolidation going here. I don't know how long this is going to go on. Just sort of died here. And now we got these equal lows down here. So we took, some pretty solid liquidity right here. Did not body close below this fair value gap yet. So for the leg for the day, or if you were to do, map the session, use your fib to map the session. This is probably our low. Yeah, so this is the day divider right here. This is 6 o'clock last night. On one side of it is 4 o'clock, one side of it is 6 o'clock. This is the hour gap in between trading. So our session low was here. And those are usually what I use for targeting when I first get in. I'll look at, up to that point what the session high is and low is. So if I'm going to fib that for the session where we're at is, it still has to come down a long way before I would say it's not going to go back up. Looking at it from this higher, perspective, I'd still like to see it come up here, and it would really give me a lot of confidence because I expect the rest of this to get taken. I just don't know if it's going to get taken right now without this getting taken up here. So most likely this is going to consolidate for a little bit. I'm going to grab some lunch, and I'll be back in 25 minutes, and that'll give the last 2 hours for us to see if we, that's sort of the end window anyway. A lot of times people don't even take trades in this time that we've been looking at through this period. It's not in the ICT windows, what have you. So I'm going to take a lunch break, get something to eat. If you're still here, I'm going to pause the video. There's no reason to record it while I'm AFK, and if you want to leave and come back or whatever, that's fine. Either way, I'm going to be here till 3, so stream will be going.